Okay, so today will be the final bit of the ALM piece of the course. We are looking at something that you all may have already, or you all will and have already covered, sorry, on the fixed income side as well, which is basically duration, duration and a little bit of convexity, but mostly to do with duration. And I will not be going into the calculations too much because I think you all would have done it at the calculation would have been done at the bond when you are doing the bond pricing and the fixed income side of the course. Having said that, we can always come back and touch back on this when we do the revision of it. The purpose here is to just try and understand the theory and the logic behind what is duration and what is convexity at the end of it, and just to try and get a feel of how we look at risk when we calculate risk and when we look at the various instruments that we have, what we are looking at in terms of how we actually look at monitoring and measuring that risk, and the tools we use to do that. So let me first start off by asking a few questions and then stepping in straight from that. What do you all know about duration? What is duration, and why is it important to us, in your own words? You can see the screen, right?
Yes, sir.
When you say what is the duration of something, what do you mean? What does the word mean? What does duration mean? In your own words, forget about the material. Just give me your own words. What does duration mean? Sunday morning, early morning. I want to wake up a little bit. What does duration mean?
So price sensitivity of bond.
No. I don't want all that. Just give me what does the word duration mean?
The time period.
It's a particular period in terms of in simple scenario.
Yeah, it's simple. It's a period. A period of, when you say what is the duration, you're asking what is the time. If you say what is the duration of a movie, you can say 1 hour and 29 minutes, or 1 hour, half an hour. So duration means a certain period. That's where you start with, right? So now we are trying to analyze in this concept of duration, how does that apply to the various instruments that we deal in financial markets, basically. Okay. How does the time to maturity deal or time to a maturity of a particular instrument that we have affect our risk profiling and our pricing of that particular instrument, or understanding the P&L impact of something? So if I were to tell you I bought a 5-year bond, yeah, what is the duration of that bond? What is the information you need for you to understand the duration of that bond? I said I bought a 5-year Treasury bill. What's the question you will ask me then?
Coupon rates.
Sorry, I can't hear you.
Coupon rate.
Coupon rate. Okay, fine. What else would you want to know? Why do you want to know the coupon rate?
To measure how much we are going to get.
How much you're going to get? Okay, right. I'll come back to that question answer. Right. What else do you want to know?
Required rate of returns.
Sorry?
Required expected return.
Expected return. So you are talking about YTM, yield to maturity.
Yes.
Okay. Right. Fine. What else?
Maturity date and coupon dates.
Coupon date, maturity date, fine, all right, 5 years, and then how when you say coupon date, you're talking about how often a coupon is paid, right?
Yes.
Okay, right. But anything else? Right. So how many of you all have done accounts, finance, accounts, any sort of accounts course? Okay, when you calculate a project, when you do a project and you decide whether this project is good or bad, what do you ask for of the project? You have a project, you're building a house, and you're going to give it on rent.
NPV.
MPV. MPV is one. There's another concept. That's a very simple concept. MPV we calculate. What will MPV calculate? If it's 100 rupees, what does MPV calculate?
The present value of the, simply say it's in the maturity, what you have got, how about present value?
Yeah, so if 100 rupees in 1 year's time, how much is worth today? Correct, no?
Yes.
Correct. So if it's like you're going to get 300-400 rupees in the next 1 year, every year, 100 rupees for 5 years, how much is that 500 rupees that you're going to get? How much is that total in today's money, the present value to get that? Correct, no? Yeah. So then how, if you have invested 500 rupees today and you're going to get 100 rupees every month, every year, what's the payback period in that?
It's 5 years.
5 years. So you look at a project, you might have something that you're going to own for 10 years and you're going to get 100 rupees every year for 10 years and you've invested 500 rupees. So your payback period is 5 years. If you are getting 100 rupees every 6 months, what's your payback period then?
2.5 years.
2.5 years. So what are you saying there? We are saying that although the project is 10 years and you have cash flows coming to you every 6 months, and you can argue that you're going to get cash, so you know your payback is, so your capital is received in 2.5 years. Now that doesn't take into account the NPV side of it, but it takes into account how long it will take you to get back your capital. Right. Now, if you look at duration is a measure of basically a dollar value on one side and also a time period on the other side. It takes into account if you have a bond on your books, or if you have a bill on your books, or loan on your books, what is the actual periodicity of that bond? Is it the 5 years or 6 years or 10 years that you have, or is it actually less than that? It also tries to calculate for you the risk you have in terms of changes in interest rates to that portfolio. If there is a change in the yield or the price, or whichever way you want to look at it, of that bond book or the particular bond or that instrument, if that happens, what exactly will be the impact to your portfolio, taking into account the periodicity of the instrument concerned. So, for example, a simple question to you: if I have given a loan to somebody for 10 years, and I have given a loan to another person also for 10 years, and one person is paying me back the whole loan as a bullet repayment in the 10th year. The other person is actually paying me back every year. So it's 10 million rupees, 10 million, 10 years. I get 10 million back in 10 years time, and I get 10 million back every month. Ignore the interest rate. It says the interest rate is the same for both. What is the more riskier proposition for you?
First one.
First one. Why is that?
The entire outstanding is remain for 10 years.
Yeah. And then if I were to ask you now, that's fine. So when I look at that, if I were to say now, give me a duration of that mortgage. For each one of those loans, what is the duration? What would you tell? Which has the higher duration? Which has the lowest? When I say duration, I'm talking about average period, right? Which one has the higher duration? Which one has the lower duration?
First one has higher duration. No?
Why is the first one higher duration? It's the same
There is
period.
no interim. There is no. Yeah, there is no interim cash flow for the repayment, and that entire outstanding is available for 10 years.
Okay, so without looking at the yield even, just from simply looking at the cash flows, what you realize is the period of the bond or the loan is the same for both, right? It's 10 years, 10 years. That doesn't change. But effectively, in your eyes, the first one has a longer period than the second one, simply because you're not getting repaid any of your capital in between in the first one. So if you calculate the duration of the first one versus the second one, first one, the full duration in terms of period is 10 years. Second one duration could be, because it's 1 million equal throughout the 10 years, it's actually half, maybe duration would be 5. So in simple words, if you take risk, what is the usual thing? Longer the period, higher or lower the risk?
Higher the risk.
Shorter the period, shorter the risk. So that's why duration is important on one side, is to try and understand the impact the period of a portfolio has on your period of an instrument has on your portfolio on one side. Second thing you're trying to understand is, now based on that, what is the impact of change in interest rates? So we assume that you have lent money at 10% to both of these parties, 10% for 10 years, for 10 million. Interest gets paid, we'll say, at maturity on the first one, along with the principal. And the second one is paid, second one you have the principal being paid every year, 1 million, 1 million, 1 million. And then you have the interest rate of 10% there also, which is paid every year to you. Now, again, when you try to calculate the duration of that, what do? You will take the interest rate and you will also try to derive the present value of that bond or the loan in this case based on the duration of the bond. So in your opinion, which has the lower risk based on the interest rate, although interest rates are both the same, which has the lower risk? First one or the second one? You're getting paid the interest also monthly, and the interest rate is the same. Which is the lower risk? Still will be the second one, because second one you're getting paid the principal monthly, and the yield, although the same, you're collecting the interest annually as well. So we'll go into that separately. Yeah, so this is what you want to get out of it. Let's just go into the. So as we say here, what is duration? It's a quantitative technique. It gives us the ability to measure the rate sensitivity of assets and liability. It's a weighted average maturity of the bond, where the present value of cash flows are used as weights, as we discussed. In computing duration, we are considering both timing magnitude of all cash flows associated with security. So this is what duration is not only important from us as from a treasury perspective, but it is also important when you're giving out and taking deposits and giving out loans from a risk perspective to a corporate, or when you're borrowing money from people as well. It gives you a good measure of what your actual period of your portfolio is if you are raising liabilities or creating assets, what is the duration you're actually creating for? Yeah. Any questions up now? So it's a measure of price volatility of a bond, as we discussed. Can be used for all assets, liabilities, and off-balance sheet items. It can be used as a single asset, a portfolio assets, or the entire balance sheet. So basically, duration helps you measure it at a single asset level, a portfolio asset level, and an entire balance sheet. So if I say my duration on my portfolio is below 1 year, right? On my one portfolio is below 1 year. What do I mean there? Does it mean I don't have a 3-year bond, or 4-year bond, or 5-year bond? Or what am I talking about there? In your own words, what am I trying to say?
Majority are in short term.
Majority are in short term. Okay. Any other definition?
It could be that your maturities are within one shorter tenor.
Okay.
So there is a five-year bonds, but your maturity is in the period of very short tenor.
Right. Okay. Good. Any other answers? So if a treasurer comes and tells you, my bond duration is less than a year, one answer is that you are saying the majority of a treasuries are or investments are below a year. What's the other definition? What's the other way of looking at it?
There could be frequent cash flows, sir.
Yes, that's also fine that you have taken long dated bonds, but you have more frequency coupon payments and installment payments more frequently. Okay, fine. See, it could also mean that you might have a whole series of bonds in terms of value numbers in the longer dated ones, but your value-wise, that is the high quantum of your value could be in the shorter date. Meaning, like for example, you could have 10 1 million bonds at 5 years, but you could have 200 million in the 3-month bucket, for example. So even though you have some long duration on your book, have a lot of long duration on your book, you might have just one single 3-month one in the 3 months, that 3-month bill in the you might have one single investment in the 3 months, large one, that sort of weighs you down. So you can't just go by looking, what it's trying to tell you is you can't just go by looking at the series of bonds that you have. You have to calculate what the values of those bonds are and what period they are in. So generally when we say the average duration is below 1 year, in this case, what you're referring to is that you have a whole series of bonds. You have bonds going up to 3 years, 4 years, 5 years. On a single level, you might be losing money or making money on single bonds. But at a portfolio level, your average duration is less than a year. So why is that important without taking into account each and every single bond that you have? From a treasury perspective, why are we looking at duration? Why am I not looking at every single investment I have and say I'm making money on this, I'm losing money on this, I sell this, I buy this? Do you think that also happens? Do you think that also happens? Yes, that happens. So the treasury would always look at each of their portfolio and see what kind of bonds they're having in the long term, and individually decide whether they want to sell it, trade it, hold it in the held to maturity book, whatever it is. They will have decisions like that they make as well. But in addition to that, you always look at things on a level at a portfolio as well. So when you're in the risk team and you're looking at the risk on the book, you are measuring it not at a bond level, but at a portfolio level on one side. How having said that, at the individual level also, you might have limits and you might have ways of measuring at each bond when you purchase a bond or sell a bond or whatever it is, what the risk is there. But generally, at a bank level, the limits are maintained to see, okay, you have a certain duration mismatch limit or a duration limit or DV1 limit in terms of the what we call present value for a basis point or dollar value for one move in dollar. You look at that limit and decide, right, okay, at a portfolio level, this is what we expect the movement to impact the portfolio, how we expect 1 basis point movement to impact portfolio. Now, I'll ask you a practical question, right? Let's go into this first figure and then we come to that. How do you calculate duration? Basically, as it says, it's a period and you take all the present value of all the cash flows coming into that bond or that loan or whatever it is, and then you divide, you multiply those cash flows and divide it by the present value of the cash flows, taking into account what the interest rate or the yield to is for each of those cash flows, yield to maturity on each of those cash flows. Like I said, we'll do the calculations later. But what it is it measures the, now, okay, so two things here. One aspect of duration is the period. We are trying to measure the actual period of an instrument that you have, which is basically, if it's a 5-year loan, 5-year maturity, interest paid or capital paid every year versus no interest, no loans paid during the year and one bullet in the end of the year. What is duration of that? Just from a period perspective. The second aspect of duration, like I said, is to analyze based on that particular duration or based on the particular duration of the bond, what is the impact of a change in price or yield on that particular instrument? What will that do to the price of the bond? So in other words, if the yield moves up 1% or 1 basis point, what will that do to the price of the bond? For that, you need the modified duration of the bond, which takes into account the period of the bond and the yield to maturity of that bond, which is then tells you, okay, fine, the actual duration, modified duration of the bond is X basically, which is the dollar amount, and then basically tells you if the price changes or the yield changes by X amount, what will the price of the bond change by? So if the yield goes up 1% or goes down 1%, based on the modified duration that you have got here, what will the price of the bond change? Is that clear? So modified duration takes into account the yield of the bond and tries to measure for you, takes into account the yield of the bond based on the duration of the bond or bill or loan or whatever it is, and tells you this is the modified duration. And if the particular instrument changes by 1% or 1 basis point, what will that do to the price of the instrument? If it's not clear, please ask.
Hello, sir.
Yes, go ahead, please.
Sir, can you say if the coupon rates are higher, the duration going to be less, no? So then also
if the coupon rates are higher, duration is going to be less. What do you think? So I'll give you an example. Coupon 5% and coupon 10%. Yeah.
Yes.
Then what would be
10%? The duration
will
going to
have
be
a what?
lower
Duration. That's right, because you're getting paid a higher coupon in between. Yeah.
So the value as well as the coupon rate also going to be effect, no, sir?
The value as well as the duration will be impacted on one side of it because you're getting paid higher, and basically because the duration is because ultimately duration is trying to figure out what your reinvestment risk is. Because what is reinvestment risk? What is
The
reinvestment
opportunity,
risk?
opportunity cost.
Sorry, opportunity cost. Yeah, so I'll give you an example, right? So I have a 5-year bond that's giving me a 5% coupon. Yeah. And now every 6 months I'll get a 5% coupon to my hand. So what is happening now? I'm getting paid money every 6 months, right? If interest rates have gone to 3%, do I have a reinvestment risk or not?
No, sir.
You do, because now you're getting paid.
We are getting 5%.
Yeah, and now the bond calculation is based on the fact that once you get your money, that you can reinvest it at the same yield that you invested at initially, right? So now every 6 months you're getting 5%. On $1 million you're getting 5%, 50,000 every 6 months. Now 50,000 you're getting, assuming that you've got that. Now you have got to go and reinvest that in the market because now that money is with you. Yeah. So you have a reinvestment risk. If market yields have for that particular period have gone up to 10%, but you've got back as 5%, you can go and reinvest at 10. So you're actually making on that. If market yields have gone to 3%, you take that 50,000 and go and invest at 3%.
Your YTM get reduced, no, sir?
Yeah, exactly. Your YTM gets reduced because at the end of the day, when you calculate the whole bond pricing at the beginning, your assumption is that you will reinvest your cash flows at the same rate that you're buying the bond at or whatever it is.
So it is a reasonable assumption because we can't predict the future interest rate.
Yeah, you can't predict it, and that's why you have reinvestment risk. That's one of the reasons that you're trying to calculate the duration also to understand what that risk is. So it is not necessarily a good thing to get your money up front in a low when interest rates are going down. Agreed?
Yes, sir.
Yeah, it's good to get your money up if interest rates are yields are expected to go up. By the reverse of buying a bond. When you buy a bond when interest rates are at the peak, and you're hoping interest rates will come down so that you make a capital gain on it. Correct?
Yes.
Yes, sir.
But when you are purely so let me put it this way: in an environment where you're expecting interest rates to go down, is it better to buy a zero coupon bond or a coupon bond?
Zero coupon bond.
Because you have a longer duration, because it's a zero coupon bond, and you don't have any coupons coming up, so your reinvestment risk is less. Interest rates come down from 10%, we'll say, to 5%. You can capital gain that and sell it off straight off at a maximum duration, maximum capital gain with zero reinvestment risk. Suddenly, interest rates are expected to go up. If interest rates are expected to go up, what would I rather have? I would have I would obviously, for some reason, I would still buy the bond, for whatever reason. But I would rather have a coupon bond where I can actually invest the coupons at a higher yield. Does that make sense?
Yes, sir.
So, did I answer your question? Sorry.
Yes, sir. Yes, sir. Correct.
Yeah.
Got it.
So now the question is, what about the coupon rate? Now, just because somebody can, you don't agree that we can have a coupon that's YTM of 8% and then coupons of 10% every 6 months. Can I have somebody issue a bond that's basically 8% yield to maturity at par, but I'm buying it at 8% because of the market 8%, but coupons of 10%? Would the price of that bond be higher or lower than the par value? Usually.
It should be lower.
If I have a bond that is YTM at 8 and coupon every 6 months of 10%, higher or lower?
It would be higher. Coupon
Higher,
side.
because you're paying a higher price because ultimately the price of the bond, the dirty price of the bond, will take into account the higher coupon. So effectively you're paying for those coupons. That's fine. Yeah. But so it doesn't matter. The premium or discount you pay on the bond will take into account the higher coupon. So net it's the same. But if you get paid a higher coupon every 6 months, it reduces your reinvestment risk, isn't it?
Yes.
So it's in an environment where you're expecting interest rates to go down further. It's okay if you it's good if you can have a high coupon bond so that you can actually in an environment where expecting interest rates to go up and you buy the bond, you have a high coupon bond that will at least give you more payments upfront for you to actually go out there and reinvest the higher bond amounts or the values that you're going to get upfront. It doesn't impact the price. The price of the bond will impact the price because you're paying more or less at the upfront. But effectively, the YTM and all that put together, net will take into account those coupons. That's fine. But from a reinvestment risk perspective, the higher coupon one will give you the ability to, if you are expecting rates to go up, to go out there and reinvest those at a higher yield. You get more rupees upfront to go and reinvest it basically. So basically, how do you calculate it? We've discussed it already. Calculate the timing and magnitude of cash flows associated with the instrument. So how often are you going to get and how much are you going to get back from the instrument? Find the present value of each cash flow. So you take the interest rate and you basically PV it like you do for any present value. And then basically for each one and then for the total amount. And we look at the weighted PV of each cash flow, find the total weight. So basically what you're saying is you look at the present value based on the duration of it, and then you have a weighted PV that you use to determine what the actual duration is. Then you by step 3, which is the weighted PV, by step 2, which is the normal PV, and you get the duration of the bond. Like I said, don't worry about calculation too much. I just want you to understand the theory and the thinking behind it more than anything else. So if your bonds with more than one coupon, what you will do is you take all the coupon maturities coming up and basically calculate the duration and divide it by the yield and all the coupons in it to arrive at what we call the modified duration. So the modified duration will tell you based on the number of coupons and the yields on those coupons how much the actual duration will adjust with the movement in 1 basis points of yield. So it's, in other words, taking into account the period, taking into account the interest rates, the coupon of those at that particular instrument, what yield they are at, and telling you, okay, on a modified basis, this is the duration from a dollar perspective. If the yield moves, this is the dollar value or rupee value or whatever of your bond movement. So let's just look at a few quick examples before we go into more descriptions. You take a 5-year 12% coupon bond. So the coupon on the bond is 12%, selling at 100, basically at par. So we say 1 million rupees, 5 years, and we'll say the 12% coupon is paid we'll say at every year. For all of this, it's every year. Coupon is paid, and you have a 10% bond selling at 100 at par, 6% and 10, and 10 year at 10%. So you have 3 with the same period, different coupons, and 1 with a higher period and a 10% coupon. All are selling at par. So in other words, it's not selling at a premium or discount. It's all done at par. Now, if you look at that, let's look at a few scenarios. Number 1. 5-year, 12% yield at 12%. 5-year coupon 10%, yield is also 10 because it's at par, and 6 and 6. Okay. So now, if you look at the 12% coupon bond, Why is the yield? Why is the duration on this lower than the one that has the 6%?
The high coupon rate.
Higher coupon. So why does the higher coupon rate affect the duration of the bond? If you are getting paid the coupon on the same period, say every year or whatever, how does it impact it? Simply because all other conditions are the same. It's 100 par and everything is the same. You're getting paid back you're getting it paid back effectively whatever you've invested faster through the coupon, right? And therefore your duration is less. So a 5-year one calculated for duration here effectively works out to only 4 years, while the 5-year 6% annually works out to 4.47. Now, if they told you that you're going to get paid all of these coupon rates at maturity, then what would be the duration on all this? If I told you that all of these bonds, 5-year bonds, you will get all your interest and capital at maturity, not annually, what will happen then?
The duration would be 5 years, entire 5 years.
5 years for all of them, because ultimately this is only happening because you're getting paid the coupon every year. And you're getting paid a higher coupon for this and lower coupon for this. Duration for this is lower, duration for this is higher. Okay, so let's look at bond next scenario. 5 years, 6%. Now this is taking into account the yield being the same. Now let's change it. Now yield to maturity, we'll looking at the last bond here, okay? This one. Now suddenly the yield has gone up on the bond. Yield has gone up. So that means you bought something when it was 6% yield. Now the yield has picked up on that bond. Or you bought it at 6%. Now here you know that the 5 years is 6%. This is the duration. Like I said, now the coupon rate and the yield to maturity have changed on the bond. Yeah. So now you have a lower yield, or I should say this one. You have a higher yield. Yeah. And you have a coupon coming in at 6% there. Now technically what is happening to the duration of the bond?
It's reduced.
It's reduced. Correct. So this is how you measure the impact of yield change on your portfolio. So for example, if you started off by buying this bond, yeah, and having this on your portfolio, suddenly the market yields pick up to 7% on that bond. Yeah, and your coupon is the same. Now the price of the bond has basically gone down ever so slightly. Yeah, but the period of the bond is now basically the same. Then there is an adjustment on the duration there, basically. It goes down. So if the yield is less, the duration will be more. If the yield is higher, the duration will be lesser. Because when the yield goes up, the price comes down. Yield comes down, the price goes up. Yeah, so that's the yield to price ratio. It's basically on the negatively correlated. So if not correlated, negative reaction to it. So higher the yield, if you buy a bond that's higher yield, even if the coupon is the same, your duration will be less. If you buy a bond with a lower yield, your duration will be more. Does that make sense? In other words, it calculates the value of the bond. So if you buy something with a zero interest rate, with a 6% coupon and somebody paying you zero interest rate, what would your duration be? Higher, right? Because you're not getting paid interest rate, you're just getting paid the annual coupon, 6 months coupon. But if you buy something that's paying you interest rate and calculated off a higher interest rate and 6% coupons also separately, when you calculate the price rate, you are getting a higher yield on it as well, irrespective of the coupons. So your duration will be less. Tell me if it's not clear. I'm sure you have covered this. I just want to make sure you're clear about it. Because the coupon will be static. That doesn't change. That's just a payment every 6 months or 1 year. This will never change through the life of the bond. This will change. This will determine the price of the bond and how much you're going to basically pay for it to or sell it off at or buy a new bond at or whatever. This is dynamic. But when you're calculating the price, you take that and the coupon payments as well, because you're going to get cash for the coupons and then calculate the price. But everybody looks at the yield YTM because the YTM will tell you the change in value, because this is static. They will tell you the change in the market value of the bond. This is the factor that will change. This and the time remaining for the bond and how many coupons are there. But this will be the determining factor for you to know whether what you bought at 6 is worth more or less in the future. So if the yield goes up, the duration comes down. If you are buying something with a higher yield, I'm talking about buying something new with a higher yield. If you buy something new, instead of buying at 6%, if I waited it until it went to 7% and bought it, it would have been a lower duration. If I waited, someone yield has come down to 5%, the duration would have been 4.48. So just imagine this situation, you want to buy a 5-year bond, the coupon is 6%, you know that. Now you can't buy that bond now, because if you buy it at 6% yield, your duration will be 4.47. That doesn't work for you because you don't want to have that. You want to keep your duration at 4.45 or less. You wait for the yield to pick up to 7% and then you buy the same bond. Its now duration is 4.45 because the yield has gone up. That's why you need to know it. Because then you can decide, even though it's the same maturity, because the yield has gone up, same maturity, same bond, same coupon, same everything, same IC and everything, but now the market yield has picked up. Because the market is picked up, you can actually buy that and your duration will be actually less because your yield is high.
But even though the yield changes, the coupon rate won't change, no?
Won't change.
So whatever the payments that you're getting will not change, right?
That's correct. Semi-annual coupons won't change, correct.
Yeah. So how does it affect the duration? Because
when you're calculating the present value of the bond, you will take the higher YTM or the lower YTM.
Oh.
When you are, if you take this here, calculating the yield,
duration.
yes, you will take into account down the pricing of the bond. You will price it based on the higher yield rather than the lower yield. So that means if the yield is 10%, your price is less than when the yield is 5%.
Yeah.
Because you are looking at what your price. Because ultimately, how do you buy a treasury bill? You buy it as a discounted or a premium instrument, depending on how much the coupon is. So if the coupon is more than the yield here, possibilities are, although it was issued at par, you might have to pay more than 100 for it.
Oh, right.
Because you're paying more because you're getting coupons at 6 and your yield is there. But most, like for example, you take treasury bills that are issued every 3 months, 6 months, 1 year treasury bills, all are at a discount, but there are no coupons in between.
Okay. Yeah.
But if you take a 2-year bond and the bond has a coupon of say 20%, current bond yields are will say 6.5%, 8%, 7%. And if you have a 20% coupon, prime possibly definitely you will have to buy it at a premium.
Yeah. So this premium or discount will also come into play here to
Exactly,
achieve
yes,
this.
depending on the coupon. But the coupon doesn't change. This will change.
Yeah. So that will change whether it's going to be a premium or discount.
That's correct. And in turn, what are you looking at in this particular thing? It's not about premium discount. It's figuring out whether your duration is going up or down.
Okay.
So if this 7% goes to say hypothetically 14%, the duration will be 3.5 years. So then in your books, when you put it in your books, you're not buying a 5-year instrument, you're effectively buying a 3.5 year instrument, although it's a 5-year bond, because you bought it at a higher yield to maturity, although the coupon is the same. So that's why, and that way you can calculate what your risk is. If you buy something at 20% as opposed to buying it at 6%, the likely chances of you losing money on it because interest rates are go up further, obviously there are other conditions to take it, are less, right? Because you bought it at a very high yield. Okay, is that clear?
Yeah.
Thank you for the question.
Thank you, sir.
Okay, just to step into the next one. So 2-year bonds, this is 6 months, 2-year 6% coupon annually, yield at 6%. Sorry, we'll take the base case. Same bond. Same one. This is what. So let's look at this one, will you? So we have this same scenario here. Yeah, and then we have a 2-year one with a 6-month coupon and 6-month yield, 6% coupon, 6% yield. The duration on it is 1.94, understood by 10-year one, which is here, the last one, 6% yield, duration is on 7.8. Do you all agree with that one? So if the yield here goes to 8%, what will happen to duration? On the last one, bond number 3, if the yield goes to 8%, what will happen to the duration of the bond?
Reduce.
Sorry?
Duration will reduce.
Reduce. And then if the yield goes to 4%, what will happen to the duration?
Increase.
Increase, right? So what it's showing you here is at the time of issuance, yield was 6, coupon was 6, 100 par, but actual duration is 7.8 because you're getting paid this coupon every year. Please ask if you're not clear. So in this scenario, what are we trying to show? Higher the maturity, greater the duration. Right? Lower the maturity, lower the duration. So that's why, coming back to example of having a portfolio and somebody saying your duration of less than a year. If somebody says your duration of less than a year, you can assume that either the yields that we have bought those bonds at are very high yields. Say, for example, you have bought bonds at 20%, 18%, 19%, and then based on, even if it's longer dated stuff, because of that, the effective duration is less, or that your maturities, actual maturities on the bond are all in the shorter dated bucket. So therefore, your duration is less, and reverse of that. Clear? Zero coupon bonds. So now let's do a scenario where the maturity is the same, yield is the same, but the coupon is changing. Earlier the coupon was static, so we have now four different bonds, which has zero coupon on one, number 4, and the higher coupon of now 8% on the first one. So now tell me the yield is not changing. So assume all the bonds are trading in the market at the same market yield. So the yield is based on market levels, but each one has a different coupon. Now tell me, looking at these scenarios, we can see that the higher coupon bond has a lower duration and the zero bond has a higher duration. You all agree with that?
So zero coupon means that you get the interest at the maturity, no?
That's correct, yes. Or you buy it at a discount, no coupon. Yeah, assuming that you're getting the interest at maturity, for what it's worth. So what is the duration? Do you agree with this?
Yes, sir.
Yes.
If all the bonds are at the par value, the yield is same, you will get more cash flow on if the coupon is high.
Yeah,
The duration
exactly.
will be
Correct. Because your one factor is if it's zero, you're not getting anything paid in between. Number one. So you're getting everything at the end. So technically, yes, you are having a higher duration because of that. And then as you get paid the coupon, the higher the amount that you get, your duration starts to reduce. And then if you get the highest coupon with the higher coupon at the same yield, your duration is less. So now I want to ask you this. Now if I'm sitting here, I want to buy a bond. Which one should I pick? What should I want to do if I'm picking something? If I want to buy this into my trading book. But what should I be looking at? If I feel, I'll give you a little more information. If I feel that interest rates are coming down, which bond should I buy? Which of the 4 should I pick?
Number
fourth
one.
one.
If I feel yields are coming down,
Should be fourth one. No, sir.
sorry, we'll start again. Who's saying number 4? I can't ask you to raise your hand, so whoever is saying number 4, just tell me yes.
Yes.
Okay. Who's saying number 1? Somebody said number 1, no? Who said number 1?
I said so. Anyway, I also agree for 4.
You changed your mind. Okay, fine. Anybody else?
Number 1.
Number 1. Okay, good. Anybody else? Okay. So people who say number 4, why do you say number 4?
Because the yield going to be low, no, sir.
Sorry, I'm sorry, I didn't hear you.
The yield going to be get low, no, sir.
Yes, so why am I buying 4 then? Everybody has the same yield, so why am I buying
The reinvestment is going to be the low.
so? But okay, that's fine. And then what's the other factor I'm looking at here?
Because all other
Sorry?
maturity is same. The maturity period is same,
Okay,
and it's bought at a par value.
okay, fine. Number 1, those who said number 1, why do you say number 1?
Since the interests are going down, so we are getting higher coupon rates, so we are interested.
So I'm expecting interest rates to go down, no?
Yes. So since we are getting a higher coupon rate, so we are better off.
Okay. So let me tell you this. Okay. So For me, the answer is number 4. I'll tell you why. Firstly, if it's a trading position, and I believe interest rates are going to go from 5%, 6% to 5%. So the YTM is going to move down. Right? I buy it today, tomorrow it goes down. 1% per annum I'm going to make on the bond, particular bond. Agreed? Because the yield has gone from 6 to 5%. Price has gone up, yield has gone down. Correct? Agreed or not agreed? If tomorrow the YTM goes to 5%, I'll make 1% per annum. If this has gone from 6 to 5, will I make money or lose money? If I buy this at 6% and the interest rates go down to 5%, will I make money or lose money?
Make money.
Make money. Because now I bought something at 6% with a higher price, so a lower price, sorry. Now it is gone down to 5% and the price has gone up, correct?
Yes.
So I have 1% gain per annum. Agreed or not?
Yes.
Okay. Now, when I calculate the total gain on it, what do I have to multiply it by? 1% now I have on a 5-year bond. I want to sell this. I have 1% on a bond on per annum, correct? Because it's gone down to 5. Yeah? Yes or no?
Yes, sir.
Okay. Now, when I calculate the total income I got from that bond, from selling the bond, if I sell it today, what's the period I have to calculate against? To calculate my gain. I have to calculate 1% into, now 1% is per annum, right? Agreed?
Yes.
Okay. So when I calculate for 5 years, what do I calculate against? 5-year bond, or what do I calculate against? I have to look at this, no? The duration. So if I buy a bond at 6%, it goes to 5%. If the duration is 5, because there are no coupons in between, I make more money, right? 5 into 5 is I make 25, 5% straight up. 5 into 4.61, I make 4.61%. 4.47% or 4.3. The higher the duration, higher the risk and higher the return if it be correct, right?
Yes.
If you're not clear, please tell me. Whether I'm making 1% or not, I'll make 1% yield on all of these bonds. But whichever bond I buy, I will make the 1% because the interest rates have gone down. But the total return I'll make will be whether the bond that I'm purchasing has coupons or not. Because when I purchased it, I would have bought it with those coupons and I would have paid the price, taking into account that there are coupons coming in between. So my effective duration is adjusted for these coupons as well, right? Which basically means that when I sell the bond, I sell it with the coupons or no coupons at all. Because if this doesn't have a coupon, I don't have a coupon to sell. So when I sell it, I'm selling it for the total duration of the bond. So the duration in this is 5 because there is no coupon in between. So when I sell it, I get the effect of a full 5-year bond, 0 coupon. But at the same time, if interest rates yields go up and the price goes down, I will have to pay 1% to whoever I'm selling it to. I will have a hit at the full impact of the bond. Same with here. Second point is you mentioned that if assuming it's this, which is it isn't, but if you take it this, in an environment where interest rates are going down, is it good for me to get paid 8% and get more money to my hand or less money to my hand? If it's 100 million, 100 rupees, and I'm getting paid 8 rupees every year, Is it better for me to get 8 rupees every year or 4 rupees every year in the interest rates going down?
4 rupees. Sir.
4 rupees. Because if interest rates are going down, I don't want to have more money in my hand. I want to have less because I want to be able to. I don't want that money to reinvest at those rates. I would have preferred to have bought the bond with a higher price at that point and left the reinvestment risk with the guy who is selling me the bond, not with me. And that would have been built into the price of the bond. But if interest rates were going up and I was buying the bond for whatever reason, then yes, I would have loved to take this bond because one is it's a lower duration. So if yields do go up, I have less risk on my books. And I get an 8% coupon, which I can then reinvest if interest rates go up, which will help me balance out the fact that yields have gone up and I'm holding something that's worth that I bought at 6%. Okay, I'll stop there and ask any questions. Any questions? Any clarifications? So think about what I said and just. Was it too fast? Sorry.
Mr. Perry, now, based on we are holding till maturity or we are trying to resell it,
Yeah.
the result will change upside down, no? Based on.
Sorry, I lost your last bit. The voice went down. Tell me again.
Based on the decision whether we are holding till maturity or whether we are trying to resell.
Yeah.
The duration that we select will differ upside down, no? Based on our decision.
Are you saying that how we calculate will differ based on that, or what is the question?
If in this, for example, if the rates are going down,
yields are going down. Yields are going down. Okay, fine.
Okay, going down. If I'm planning to hold it till maturity,
yeah,
the bond, the first bond will be feasible for me to go as an investment to have it in my portfolio.
Not really, no. Because even if I hold to maturity available for sale or trading, is purely how you measure it on your P&L, right, or your equity. You put it in one of those books so that you don't have. You manage the volatility on your P&L on the mark to market. So, for example, if I buy a bond today and I decide I'm putting to held to maturity, it could be because I want it as a long-term hedge on my liability book, for example, or that I feel it's a good time to buy because interest rates are at a good yield and it sort of complements my balance sheet. But I don't want to trade it. I don't have any intention of trading this, right? So I just want to keep it in my books and enjoy the interest rate, enjoy the coupons, and just happily keep it there and not have the P&L volatility. You agree with that, no? Basically, right? Now, but when I value the portfolio, if I want to value it, I have to value it against the market rate. So although we don't take a P&L impact, there is a mark-to-market issue there. So for example, if I'm holding on to $1 billion worth of held-to-maturity bonds in that 5-year one, the number one bond, and suddenly, I have a liquidity issue and I get permission from my regulator, whoever it is, that look, I need to sell those bonds because I have the money, I need the cash. Where do I go and sell it at? If interest rates have gone to now 20%, right? I have to go and sell it at a loss, correct? No?
Yeah.
So that doesn't change. That's number one. Second thing is on what you said about the coupons. Now, even though it's a held to maturity bond, I still have the reinvestment risk, right? I mean,
at the point of maturity, you have to reinvest.
Yeah, the coupons, every time the coupons come to my books, I have to reinvest that, right? So if yields have gone from 6% to 3%, I'm only investing those coupons at 3%. So it's important that at the time of buying the bond into that HTM portfolio or whatever you want to call it, right? You are buying it at the correct yield and you have an idea what the coupons are on that bond. Does that make sense? Even though you're not going to trade it around, you still have that reinvestment risk. That doesn't stop. But at the time of buying the bond, you're taking into account all that and purchasing it. But definitely with the yields changing, you have that issue. But you're assuming that you're reinvesting the coupon at that coupon rate, to answer your question.
Yeah, because even if I get it at 8%, if the rate's at 4%, I'll have to reinvest it at only 4%.
Exactly, yes. So it's not always good to get your money, a lot of money up front. You have to have a view on where the interest rates are. So look at the current environment. If you have bought bonds and they were paying you 5%, 6% coupons, right? Interest rates are going up. You're losing money on the bonds you bought in terms of the yield, YTM. You're still holding on to that, right? But your coupons, if you have got a higher coupon rate or if you have got higher coupons, at least you can get that at a higher reinvestment return on that. But yes, from a duration perspective, at the time of you buying a bond, you have a lower duration because you're getting a higher bond, and purely from a periodicity point of view, it reduces because you're getting back your principal in one form or the other. Whatever you insist, you're getting back faster, you're getting interest faster, but the duration is less because of that. But if you, from a trading perspective, and you expect interest rates to go down, high duration is better. You don't want the coupon upfront or payments between. Because you are monitoring this to see the maximum duration you can put on your books. See, if I believe strongly that interest rates are coming down or yields are coming down, I'm going to go and buy the longest duration bond that I can get so that I can maximize on my return. If I believe interest rates are going up, I would want to keep my duration as low as possible so that I can enter the market at the right time.
Sir, can you explain that first scenario?
First one.
Yeah.
This one?
No, I mean that what you explained right now.
So
goes to 20%. You said.
Sorry, I didn't get you. Tell me again.
You said that interest rate will go up 20%. Then we are going to lose that. How that happens?
So if I buy a bond and interest rates go up, is it?
Yeah.
So, for example, if I buy a bond today at when interest rates are 6%, and interest rates go to, when I say interest rates, I'm talking about YTM, which goes to 10%. Am I making money or losing money on that particular instrument? Losing because now what I bought at 6, which has a price of say 95 at that time, as now the yield has gone to 10 and the price has gone to 90. So now when I want to go, if I want to go and sell that bond in the market, I can't get 95 anymore because yields have picked up. I can only get 95. Correct?
Yes, sir.
Okay. So now, if I believe interest rates are coming down, I would then take the 6% bond that I'm referring to. I go and buy the 6% because depending on how strongly I believe interest rates are coming down, I would want to go and buy the bond with the lowest or the highest duration, lowest coupon. So for me, this is the most riskiest bond, meaning 6%, 5-year duration, no coupons, interest rates I expect to go down by 1%. I am very, very, very convinced it will go down by 1%. And if the price is 95, I go and buy it at 95. Okay, done. Interest rates go to 5%. Am I making money on any of these bonds? Once if I buy it at yield as 6%, if interest rates go to 5%, am I making money immediately on those bonds or any of these bonds? Agreed or not agreed? I will make money, right?
Yes, sir.
Yeah. How much money I will make? How much money I will make is based on what? If they are equal tenor, how much money I will make based on what?
Yield.
Yield is all gone down to 5%. So everybody has gone from 6 to 5. 6 to 5, tenor is the same. I'm selling all the bonds on the same date. Nothing wrong. I bought it all at 6% and I'm all selling all of it at 5%. Which one will give you the most amount of money?
That's coupon rate, no, sir?
Yes. So how do I know that which bond will give you the? I can look at this and tell you which one will give you the most amount of money. If interest rates go down.
First one.
First one, number 1.
Interest rates go from 6 to 5. Will I make money on all of these bonds? Just answer my question, yes or no. If interest rates are 6%, I bought it at, now interest rates have gone to 5. Will I make money on all of these bonds?
Yes.
Yes. I'm selling them all on the same day. Now, which one will I make most amount of money on by selling it?
First bond.
Okay, any other answers?
So that
Okay.
should be the lower coupon, no?
Okay, so one question. How much of a profit am I making? 6% goes to 5%. How much of a profit am I making on the bond? Percentage wise?
1%.
1%. Is it 1% per annum, right? Agreed?
Yes.
Okay. So now on the first one, I made 1% per annum. For the 5 years, how much of money am I making percentage wise? Five-year bond, 1% it has gone down. How much am I making on the first bond, or percentage wise? 1% per annum, you said?
It's 5%.
Am I making 5% here? What's the duration?
$4.3.
Yeah, so I'm actually 1% into 4.34 means I'm making 4.34%. That's the effective duration of the bond because of the coupon. Where am I making 5% in this 4 bonds? Where am I making the full 5% benefit?
Fourth one.
Fourth one, because there are no coupons, right? So when I calculate the duration of the bond, I'm taking into account there are coupons in between. So the interest rates have gone down by 1% and I'm going to make 1% per annum. I can't take the full 1% per annum for these bonds because there is a coupon in between that I have to take into account when I calculate the value of the bond, which basically brings down the duration to 4.34. When I paid for the bond and bought it, I have done that calculation. When I'm selling it also, I've done the calculation. Here, when I bought it, I take into account that I don't get a coupon in between. And when I sell it also, I take into account there's no coupon for me to give in between for this bond. So which basically means I have a full 5-year, 5% benefit on the bond. So if it goes down by 1%, 1% into the remaining period. Here, if it goes down by 1%, 1% into the duration, which is not the remaining period exactly, it's slightly less than the remaining period compared to this. Understand or not?
Oh, okay, sir. Understood.
Everybody else? Because everybody said 1, so I want to make sure everybody is clear about that. If it's not, we will clarify and go ahead.
Yes, sir. As per this example, the last one is the most profitable one.
Profitable and more risky as well, right?
And if we see slide number 14, as per that, that is first 14.
14.
Yeah. In this example, the first one is the most profitable one, no? Because as per the
Depends on you're talking about number one here, is it?
yeah, number one, yeah.
No, again, it's like this. The duration is less.
Yeah.
So if your belief is interest rates are going down, if you buy it at 12, and if you believe interest rates are going down, right, then you should ideally buy this one. I mean, you're buying this at a higher yield, that's fine. But the coupon is also 12. Duration is less. But if you believe interest rates are going down, this one, looking at these three options, this has a better duration. Because interest rates go down to 5%, you make more. And here, where interest rates are, although you're buying it at 12, your coupon is also 12, right? So the duration is less. If you have bought this here and the duration was less, the coupon was less, then the duration would be more. Then you would have a higher thing there, like this here. Number 4. So that's what I'm saying. Sorry, go ahead.
So as per this example, the third one is the most profitable one.
Yes, exactly. Depending on what you want to do, because you can't just look at the yield and the coupon and you can't just look in one in isolation. You have to look at both, and then that's why you look at this number to see what the duration is. So looking at this, it looks like, oh yeah, I buy this one. It's really good because I can then make, if interest rates go down to 5%, you probably make more money if it goes 5. But if interest rates go down 1% here, or if interest rates go down 1% here, which one will give me more money? Number 3, because the duration is more. The likelihood of interest rates going down at 12% is more than interest rates going down at 5. That's a monetary policy thing, monetary thing, right? But assuming that interest rates can go down, because when I buy the bond at 12% yield, there's a high coupon. So I'm taking that into account. If the coupon was 6%, then this duration would effectively be higher. Or low or whatever. But basically what I'm trying to say is this is the same thing, basically.
Yes, sir. Then what about the second table?
This one?
No, same page, 14. Page number 14, the second table, yeah, this one.
Yes.
So what about the...
So here, if you look at it, yield is 7, coupon is 6, duration is less.
So
than the one that has the same coupon here, basically. So because the yield is higher, coupon is lesser. Now, compare this to this, right? 6%, you get 4.47. Suddenly the yield goes up, coupon remains the same. Yeah? Your duration goes down because you are getting a higher yield, although the coupon is the same. Yeah?
Yeah.
Here, coupon is the same, but your yield is coming down, your duration increases. So in this one, this 12%, number 1, if the coupon comes down, also the duration will pick up. The coupon comes down, the duration will pick up. Yeah. So if your question is, if the coupon comes to 6%, yield is at 12, then the duration on this should be effectively what should happen to the duration? Compared to this one, so look at this 6%, 4.47. Yield goes up, duration comes down because the yield has gone up. Yeah. So in this way also, if the yield goes up, you are going to reduce your duration if the coupon remains the same. Bottom line is, don't get confused. I think main thing is look at how your cash flows are. If you're getting back your cash flows either by way of the coupon or the higher yield, your duration will come down. Right? In this case, it doesn't make an impact because both the coupon and the yield are the same, right? And basically here also is the same, but here the duration is less because ultimate duration is more because the yield and the coupon are less in terms of interest rates. If this was higher, like here, your duration will be less. But if one of these factors changed, if the yield got higher, your price would go down. If this yield has got higher, your duration would go down. If now, for example, you're getting 12% and yield goes to 13%, your duration will come down, like here. If your coupon was 10% and this was 12, then your duration would go will go higher. Here, if the interest in yields go to 14%, your duration will get lower. Now here we are talking equal terms, so it's confusing because of that, right? But in this case, for example, it's the same bond with a lower thing, so you're getting a higher duration because of the lower yield. But if you want to then look at whether you buy the bond or not, you get a higher return by the bond going up because the duration is actually higher here. Because the coupon rate and the yield are both very, very low here, but equal. So the higher the change in the interest rate here, the impact or the 1% change here will have a bigger impact than a 1% change here, because the duration is much more, although you're buying the same bond or whatever it is. Because look at it this way, 1% change on 12% is how much effectively? It's about a 8% move on the bond. 1% change on 6% is effectively how much? A 1% change on 6% is how much? About a change of about effectively about about 10 to 12%, right? You agree?
Yes.
So the change on the same yield change doesn't have the percentage difference. It's the same percentage. It doesn't have the same percentage difference. 1% change on a 12% instrument is effectively, if you take it, 8.3%, right? 1% change on a 6% instrument is 1.6%. So because of the change in the yield, your duration here calculates the fact that you're making a higher return if that yield goes up. Same way you lose more if the yield goes up, basically.
Yes, sir. So if we look at that second table, the most profitable one will be the sixth one, no?
That's correct. Depending on what happens with rates, yes. If the yield goes from 5% to 4%, this is the bond you want to own. Correct.
Okay. Then same like that. If we see the slide number 15.
15, okay.
So this one also, the profitable one will be the first one, no?
No, the last one.
Last one, sorry.
Because here the coupon and the yield are all the same. It's just the period that's changing, right?
Yes.
It's purely on the tenor.
Okay.
Okay. Sorry. Any other questions? No problem. So basically, before we go for a break, we'll just recap. Look at the slide 18.
Sir, I have a small question.
Yes, please.
Sir, so what you have to buy is the which bond having the highest duration. Is it since
Highest? If you're taking a trading position and you want to monetize a view on interest rates, so in this case we say interest rates are going down, you will buy the bond with the highest duration. If you believe interest rates are going up, but you still need to buy instrument into your books, you will buy the instrument with the lowest duration. Depends on what you want to do.
So that is based on the reinvestment risk. Is that right?
Not only reinvestment risk, but on the yield as well. What yield you're buying it? YTM.
Okay.
Generally, everything is looked at based on the YTM. Where are bond yields? Or where are what interest rates are you lending at or borrowing at? So the coupon is taken into account when you look at the price of the bond, yes.
So,
But generally, sorry?
sorry, if so that yield comes into account if you are trading it, right? If you're holding it, would
Still the same, no? Still the same. If I
Why?
am holding it, I would want to buy it at the highest yield and the lowest price, right?
right?
So
But
yes, I would look at the price. I would look at the yield first to see, okay, fine. What yield is it? Is it 10% or 12%? Agreed? That's my
yes,
first.
yes.
Then I will look at the price to see what am I paying for it based on the coupons coming through.
Okay.
And then
Yeah.
decide, okay, is it a good bond to put on my books?
Yeah, right. So then after that, if the yield changes,
Yeah.
right? So if you're holding it until maturity, would you have a sort of a impact?
I would have a concern if I have bought, say, for example, this first bond.
Okay.
Number one, if I bought at 6%, now I know the duration is 4.34, and now suddenly interest rates will say go down,
Okay.
right? Now, from a trading perspective, I'm happy because interest rates have gone, yields have gone down, so effectively it's good for me. I would have rather had to have this, but now this is on my held to maturity book. Now, what am I getting paid? Coupons at 8%, right?
Yes.
So now I have to reinvest this. Now interest rates have gone to 5% or 3% or 4%. I have a reinvestment risk, right?
Yeah. Yeah. True.
So I would be concerned from that perspective what to do with the money, because
Oh.
it's based on the assumption that I'm reinvesting this also at this 6% yield, right?
When you purchase it, yeah, you had the same.
Yes. So I have carried that reinvestment risk on a low interest rate environment where the coupon is higher than the YTM at the time of me purchasing.
Yes.
So yeah, so it's not a perfect science, but generally when you buy the bond, you have to see whether it has exorbitant coupons and what your view on rates are. But generally the YTM will take into account the price you're buying it. And generally a lot of people don't look at that reinvestment rate too much because it's not a big disparity between the YTM and the coupons generally.
Okay. All right. Okay.
It's a very small thing.
Yeah.
Even the fourth bond, the zero coupon bond,
Yeah.
which I bought for 6%.
Yes.
If the interest rates are going down,
Yes.
still if I hold till, I mean, I'll have to anyway hold till maturity to get the returns, no?
Yes.
So,
Yeah.
but that also, if I hold till maturity, then again even from the first bond or the fourth bond, the reinvestment risk is the same, no, for both.
No, not at all, because you're not getting a coupon that you have to worry about reinvesting.
No, in the sense I'm talking about the maturity face value that I get.
Yeah, so when you buy this, you're going to get 6% at the maturity. You don't have to worry about reinvesting at 6%. They're going to calculate and give you 6% at the maturity, right?
Yeah.
Here, whatever you are getting at 8%, you have to go and find a way of reinvesting at 6% yourself. It's up to you. Here, they're not paying you anything in between. They're not paying you upfront. They're not paying anything. So you are going to get 5 after 5 years, they'll give you 6%. Here you go. Here's your money. Calculated and gave you. Here you will get money every 6 months or 1 year. We say you have to go and find something that'll give you 6% so that you're in line with what you thought. If the rates are 3%, for those coupons, you're going to be running a 3% deficit. Because it's your problem what you do with the bond. Here they're going to reinvest it and they're going to give you the money, basically.
Okay.
You understand? But here the coupon that you get, if the rates have gone 15%, you're going to be able to reinvest those coupons at 15% and get a higher, effectively higher rate yield. Here, you won't have that choice. Think of a deposit. You put a 5-year deposit, interest every month, every year. They pay you 6%. Now, when you get the interest every year, what are you going to do with the interest? If interest rates have, if you got it at effectively like 10% per annum, interest rates are 5 now. 1 million rupees. You got 100,000 in the first year. What are you going to do with the 100? Where are you going to invest 100,000? At 5%, right?
Yeah.
But if you have interest at maturity, 5 years, 1 million, 500,000 rupees, you will get at maturity, correct?
Yeah.
Simple. But now you're going to get 100,000 every year, and now you want to reinvest that 100,000, right? If it's compounded interest on the other one, they'll compound it and they'll pay you X amount at maturity, correct? Effective rate will, interest rate will take into that account of that. AER will take that into account. Right? This one, you have to reinvest your coupon, right? Is that clear?
Yeah, because the main decision-making point will be the in between cash flows that we receive. What are we going to do with that? No?
Exactly, and what will happen with rates? Now, some people have a natural requirement; they need the cash. Whether it's for other purposes, cash flow requirements in terms of maybe if it's a individual for living expenses, or you have some other commitment, so you don't mind taking that. And there's nothing wrong with the coupon. I mean, that's perfectly fine. But it all depends on what your view on rates are. And most instruments are issued with a coupon. So there's no choice. Very few zero coupon because you want to reduce the risk also, no?
Yeah.
You don't want to have a situation where everything is in 5 years. No, it's a high risk, right? This is. You want to get paid something annually as well. And there is a reinvestment risk, but as long as the coupon and the yield are sort of in line with where the market yields are, it's fine. So some people will want a high coupon, but that means if it's a high coupon, lower yield, then your duration will basically reduce because you're getting paid a lot. Like if you have a 20% coupon and 8%, your one thing is your price will reflect the thing. You'll have to pay a higher price rate, higher than par, but you will get back that money also faster over a period of time. That's why you're paying such a high price, right? But you run the fact 20% coupon, you must be 100% sure that interest rates are not going to come down. If they do come down, you're going to be landed with a lot of money up front that you don't know what to do with. If the rate is less than the YTM at the time of buying. Generally, what you do is you look at the price of the bond. Price takes into account all the thing, and then you look at the duration of the bond. Then you look at the price. The price will take into account the coupons, all that is factored in. So whatever. But in our markets, everybody talks in terms of rates. No, rate is 5%, 6%, 7%. But in reality, we should look at the price. The price will take into account the coupons that you're getting, everything. So you're looking at the price of the bond. Price is 97, 98, 99. It takes into account all these coupons, everything, right? And then in terms of risk, you figure out what the duration is by looking at what the risk is by looking at the duration of the bond. The 5-year duration of the bond priced at 98 or whatever it is. That's how they'll say. Okay, so just before we end that, yes.
So usually zero coupon rates are given by Treasury bills, right? So
sorry, I didn't get you. What rates are given by Treasury?
Zero coupon rates applied only to Treasury bonds, no? Treasury bills.
Treasury bills, but that also they pay it at a discount, no?
Yes.
So you technically get your interest at upfront. So there are situations where zero coupon bonds are issued with a deep discount, where you actually get the interest upfront for that.
Bonds are also there with zero coupon.
Zero coupon bonds, which basically you're right, treasury bills, all of those are zero coupon bonds basically.
Yes, sir, but treasury bonds are not available with zero coupons. Are they available in Sri Lanka?
No, not in Sri Lanka, but you get zero coupon bonds issued in other places also. So then if you have a 5-year bond with a zero coupon and discounted, deep discount, that means you pay for a 5-year bond that is 100 par. You pay a discount at zero coupon, you pay like, you might pay 50 to buy it. You get the interest upfront for that.
Okay, sir. Sir, okay, another thing, you mentioned about that 1% change in 15%. Can you remember if you can?
Sorry, I can't hear you. What's the
you mentioned earlier about 1% change in 15%, something like that. I didn't understand.
No, so if for example, if you're on a 5-year bond, the yield changes 1%. You buy the bond today, 5 years to maturity, tomorrow it goes down to 5%. 6% to 5%. How much of a change has there been then? If the yield on the bond goes from 6 to 5, how much of a change is that?
1%.
1%. Is it 1% per annum?
Yes.
Okay. So on a 5-year instrument, 1% per annum means what's the total change on the value of the bond from a yield perspective?
So depending on the duration.
Exactly. So if it's a 1% change on the first bond, what is the percentage change, assuming it's 4.34, what's the percentage change on that particular 5-year bond?
4.34.
Yes. And if it's a 5-year bond here?
So 5%.
5%. So basically, if the interest rates have gone down, it has a 4.34% impact on this bond and a 5% impact on this bond. Correct?
Yes.
So which has the bigger impact?
Fourth one.
Fourth one. So bigger return or bigger risk is?
Fourth one.
Okay. That's what I was saying. I'll explain.
Oh, okay, sir. Okay. Okay, sir. Thank you.
So from what we just summarizing what we just did, high risk, long duration. If it's a low coupon, longer duration, and longer maturity, sorry, and low yield, low coupon, low yield, long maturity, high risk, long duration. Higher coupon, shorter duration, and higher yield to maturity. Sorry, lower risk, short view. So obviously there can be combinations of all this, but if you have one bond that has all these properties, then this is basically the lowest risk. So you have 3% coupon, 3% coupon, and 1 year or 2 years. 3% coupon, 3% 2-year maturity, and 3% yield to maturity. Very low risk. 12% coupon, very low. 12% coupon, 12% yield to maturity, and what do you call this? 2-year risk. Then you have a 2-year maturity. Then you have a low risk there. So the maturity works inverse to the coupons basically. So the shorter the maturity, the lower the risk. The higher the coupon and the yield rates are, lower the risk. And the reverse. Is that clear? All right, let's take a break. We don't have too much more to do today, just the basis points part of it. And then we're done. So we'll meet back at about 10:35, 10:40. So we spend the morning discussing duration and calculating it, as well as more importantly, understand the concept around it and identifying your risk based on your based on duration, based on the price of the bond, the coupons of the bond, and basically figuring out how you look at duration from the lens of a treasurer's or risk manager's perspective, so that you identify how your actual risk on your book is and what you need to move forward. Now, ultimately, you do all that. You understand your risk. You take example that we were talking about earlier. You know what your duration on this bond is: one first bond, second bond, third bond, fourth bond, and then we look at coming up and saying, okay, fine, this is the bond I want to buy, and this is the risk I put on my books as soon as I buy it. Now, as we discussed in the morning, this 6% bond that is mentioned here, if interest rates go down by 1%, the higher risk is on the 4 years and the lower risk is on the 1 year because of the duration. Now, in terms of measuring that risk, what that risk is, there's a concept that we use, right? And to use that concept, we use something called the basis point value. It's also called DV1, dollar value of 1 basis points. What does that mean? What's a basis point? First tell me that. What's the basis point?
0.01%, no, sir?
0.01%. That's correct. So if I were to say the bond moved by 1%, how many basis points has it moved?
It is 100%, 100 basis points.
100 basis points. So why are we looking at the DV1 or basis point value 1? Why are we looking at that? What are we trying to measure?
Modified duration.
No, leave all that aside. If I want to say if I ask you what my DV1 value is, what am I trying to get out of it?
Percentage in price. Percentage change in price.
If I say my DV1 is $1,000 positive, what do I mean?
The reaction.
The reaction in what terms?
Price.
In what terms? No, not price.
Yield.
No. DV1 is $1,000. What am I saying?
The gain or loss?
Exactly. In what terms?
In perspective to the price, the actual gain that I'm going to get of this deviation.
In what terms? Dollar terms, for example. I'm going to say $1,000. If the yield comes down by 1% or 1 basis point, my dollar value of that is $1,000 per basis point. So how does that help me?
To evaluate your gain or loss.
Exactly. So if I have a bond portfolio and I tell somebody, my trader comes and say your DV1 is $10,000. A DV1 is $10,000, right? And yields go down by 1%. How much of a gain do I have on that portfolio?
$1 million.
1 million, because 100 basis points into $1,000 or 10,000, whatever it is, multiplied by 100 into that basis point value will tell me at a very high level what my dollar gain on my portfolio, or if you look at it the other way, if the yields go up, what my impact is. So basis point value, a change, 1 basis point change in interest rate, what is the change of a value of a portfolio?
It's similar to mark to market.
It is similar to mark to market, but it takes into account the duration of you have to take it to get the value of it. you have to take the modified duration into account. Basically, it is similar to mark-to-market, yes, but it takes into account the sensitivity of the yield curve and the duration of the yield curve. It's like this. Mark-to-market is there, but this takes into account how the value of the portfolio will change across the curve at a portfolio level. You're conceptually you're right, but what I'm trying to say is this will tell you how much of a valuation change is there on your curve itself. Yeah, so let's go into the calculation a bit. So you're looking at a portfolio value of rupees 12 million. Modified duration is 3.2%. Yeah. So in other words, if the portfolio value moves by 1 basis points on a 12 million rupee portfolio with the modified duration of 3.12, which takes into account the DV1, what is the present value for the portfolio value or the basis point value of a portfolio? For 1 basis point, the rupee value is 3,744. In other words, if yields come down by 1%, yeah, 1 basis point. So basically, if the interest rates change by 1 basis point, higher or lower, we'll say it goes down by 1 basis point. Your portfolio of 12 million, based on the modified duration, would move by 3,744. Negative or positive. If interest rates have come down, it will be moved by positive of 3,144. Is that clear?
Mr. Perry, here the M duration for 3.12% is for DV1 or 100?
This is the modified duration of the entire portfolio.
Yeah, that is referring to the 1% of yield change, no?
1% of yield change is here. That's right. So sorry.
The 1 divided by 100 refers to DV1, no?
DV1 is correct. Yeah.
In the sense 1 basis point.
1 basis points, correct. Yes.
Yeah. But 3.12 is for 1% change in the yield.
That's right. Correct. Yes.
Thank you.
So let's go more into detail. So value of the portfolio is 100 million. The dollar value one of the portfolio is 67,000. So this number, EV1 is 67,000. What is the modified? So you reverse it basically. You have the DB1 in this, and you're trying to figure out what the modified duration is 6.67% for 100. So basically, here you have the modified duration, and you figure out what the basis point, 1 basis point move will have on the as a rupee value. Here you have the rupee value, and you just plug that into your formula to arrive at what the modified duration of the portfolio is. It's the same thing reversed the other way around, basically. So what it's trying to tell you is, if you have only one component of your calculation, you have either the modified durations or somebody says my DV1 is 67,000 and your portfolio is 100 million, you can sort of reverse engineer that and say, okay, his modified duration is 6.75%. So in other words, for 1 percentage point yield change, his portfolio will move by 6.75% in the opposite direction, based on the duration of the portfolio and the yield that he has. So modified duration will calculate the percentage change or the percentage of your portfolio that is sensitive to a yield change. The 1 basis points will calculate what that movement looks like in dollar terms or rupee terms. Is that clear?
Sir, the minus or positive value means it's a profit or loss. Is it the case? We can decide.
That's right. Yes. So if you say you're 67,000 and interest rates go down 1%, if you have a portfolio and yield goes down 1%, you should be positive. Yields go up positive, it should be negative 67,000. That is based on the movement, which direction it moves on. That this is not taken into that account. This is taken into account what the impact on the portfolio is for 1 basis point, higher or lower. But yes, depending on what kind of portfolio you're carrying, at what yields you purchased it, if the basis point is lower, then you can say, okay, fine, this is the impact. So for example, if somebody comes and tells me, look, my DV1 is 67,000 and then interest rates go up, positive 67,000, interest rates go up, right? Obviously, it's going to be a loss for me. By each basis points going up, I'm losing 67,000 rupees. If he says, look, 67,000 interest rates come down, it's going to be positive for me, basically.
Sir, can the BPV can be a positive or negative? That means when you given that amount.
From a portfolio perspective, it can be. In this particular instance, now let's look at the next one. Let's go, when you go up this, you will probably be a little more clearer. Let's take it to the next one. Consider a bond, 5 years, 10% coupon, right? Change in yield, 1% up, 2% up, right? So when that particular bond, suddenly the duration, modified duration is 3.79 years. So in other words, you bought a 5-year bond with a 10% coupon. The actual modified duration of that bond is 3.79%, right? So what are you saying?
Sorry to interrupt. Here the modified duration is 3.79. It is a percentage or it says years?
Percentage that you adjust to the price.
No, in the bullet point, modified duration is 3.79 years. It says. Is that the way that it's represented?
Yeah. So what happens is that because duration is taken by the tenor of the bond, right? When you take a 5-year bond, you will adjust the coupons to arrive at a tenor. That's number one, right? So when you have done that, and then that's the duration of the bond, right? And then if you look at the calculation of modified duration here, measures a change in market value of the bond resulting from a small change in interest rates, price elasticity, right? So it is calculated by the duration of the bond, which is 3.79 years, right? And then you adjust it for a yield change to come up with what the percentage of the bond would be based on that duration of it, or the price change will be based on the duration of the bond and the yield change that you're talking about, right? So it is translated from a period to a percentage so that you adjust it to the price.
So even if that 3.79 is reflected as modified duration 3.79 percentage, it's still the same, no?
It's the same thing, just the same thing that you're looking at here. So let's look at the calculation here, then you'll understand. So here is 3.79 years. So the price of the bond is say 100, but you're basically adjusting it to the modified duration to get the new value of the bond. If it goes down by say 1%. So in other words, it's issued at par. When you buy it at par, it's 100. The coupon is 10. Suddenly the interest rates go up by 1%. Okay. So you know the duration is 3.79. You modify it by make it into a percentage from like what we saw just now. And the new value, because the yield has gone up, the price has come down by that value of the bond, because you know what the modified duration is. 1% into 3.79 is 3.79%. For one, the price is now 96.21 because it has gone down by 3.79% because of a 1% move, because the duration is 3.79. So think of it this way. If this is a zero coupon bond, I'm sorry to complicate it, but just to make you understand. If a zero coupon bond, right, and it's 5 years, we discussed it. There's no duration. It's a full 5 years, correct? Do you all agree with that?
Yes.
Right. So, so basically, take the zero coupon bond, right, and assume that the duration of that is 5 throughout, right? Now the interest rates go up 1%. What happens to the bond? 5 years to go, 1% annualized change, so 100 basis points move per annum. Bond price goes down by 5%. Agreed? Agreed?
Yes.
Then the price will be now 95, correct? Because the modified duration on that bond will be 5 years. 5 years into 100 basis points is 5%. It goes down to 95. Here, the modified duration, because of the coupons and all this other stuff that is in the bond, is 3.75 years. Correct?
Yes, sir.
So it actually goes down to 96.
Yes.
Okay, right. You can hear me, right?
Yes, sir.
Yeah, so basically now if you take the second scenario, interest rates go up by 2%. Now in that scenario, your modified duration is 200 basis points into the duration, the bond price goes down, because when yields go up, the price comes down. So automatically you will take the price of the bond and reduce the percentage it goes down by to get the price. So that answers your question about how you will look at the dollar price of the bond. Whether it's higher or lower will be the direction in which the bond goes at, basically. Yeah. So if the yield goes up, what happens to the price of the bond, of the instrument?
It's down.
Sorry?
Comes down.
Comes down. So if the yield has gone up 1% based on the duration, the price has come down by 3.79%. Based on the duration, the price will come down to 96. Yield goes up 2%. It comes down by 7.58%. 100 bond comes down in value to 92. Yield goes down 1%. Same duration doesn't change. Modified duration doesn't change. Percentage doesn't change. But the direction changes. Price goes up. So the value of the bond goes up. Yield goes up 2%. Same thing happens. So the duration will tell you duration is static. That doesn't change. Modified duration will tell you, okay, this is the percent period that you have there. The value of the basis points will tell you how much that means in terms of a percentage move, how much of impact that will have on your portfolio. So if you take a 1% move, it will have a 3.75% move on your portfolio, higher or lower, right? So 1 basis points will then account for 0.379% or whatever is that. But basically, if you have a duration of 3.75, and yields pick up by 1%, it has a 3.79. So that means per basis point, it will be 0.37 or whatever it is as a dollar value of a move on that particular bond. So what are the things you have to understand here? The modified duration calculates, the duration will calculate the tenor, modified duration will calculate ultimately the percentage based on that tenor. The basis point value will tell you the dollar value based on a percentage move on your portfolio. So now you have the new price, right? Now let's look at it this way. Now that means if you take this one, the price has gone down to 96 from being 100, 96.21 from being 100. In other words, your price has moved from being worth $100 rupee bond, now it's only worth 96. In other words, your price change has been 3,790 or whatever it is for each basis point move on a bond or on that particular bond. That's your for 100 basis. So 1 basis points will be 379 for one DV1 is 379 for that particular bond. Is that clear?
Yes, sir. Simply say that if you know the modified duration for your entire portfolio, that you can get the new values as per the change of interest rates. No?
Exactly right. Exactly. And the direction of interest rate. Huh?
Yes.
Because the direction will tell you whether you're based on the portfolio carrying, if it's going up or down, whether the price has gone up or down based on the modified duration, or the value has gone up and down based on the modified duration.
If your portfolio has lesser duration, modified duration, that means that impact to the values in positive or negative side is much lesser than if the modified duration is having a higher value.
100% right. So I'll bring a practical example in here. In this current environment, if you are carrying a bond portfolio, interest rates started going up. Who would have been in a better position? Person with a higher modified duration or lower modified duration?
The rate was going down.
Yields were going up. Now, till 2 weeks ago, if you all know what's been happening in the bond market, till 2 weeks ago, the 3-year bond yields and the 5-year bond yields were like maybe 7.5%, 7.25%, 7.5% interest rates. Now the 3 years is up to 8.5%, 8.1%, and the 5 years is about 8.5% interest yields. Now, that means what has happened to the bond yields?
Going up.
Right, gone up. So, what is better, a person who carry the lower modified duration or a higher modified duration?
Low modified duration.
Lower modified duration. Yeah, because yields have gone up, prices have come down. If you are carrying a higher modified duration, ultimately your DV1 would have been much bigger impact, much bigger DV1, which would have impacted in a much bigger dollar value change in a negative for you on your portfolio. So when do we increase duration? When do we want to, how do we increase duration? And when do we increase duration?
When the interest rate expectation is when the interest is getting lower expectation.
Increase duration. When would I want to increase duration?
That when the market rates are in high level.
Rates when you say yields, right?
Yes, yields are in high rates, in high side, and we are expecting that in future that rate will come down.
Fine. So I go out and then buy. What would I want to go and buy then? How can I increase my duration? What are the 2 ways I can increase my duration?
To purchase high yield bonds?
Sorry, one at a time. What was that? First one you said? Purchase?
Lower coupon?
High yield bond?
High yield bond. Coupon will be taken into account, we'll say, with the bond price. high yield, and what's the other way I can do it?
Maturity of the bond.
Maturity of the bond. So I can purchase, maybe I can do it in two ways. I can purchase a 10-year bond at 9% or double a 5-year bond at 8%. I can purchase 100 million 10 years, or I can purchase 200 million 5 years, correct?
Yes.
Effectively, it will give me the similar sort of duration, right? Either I can extend tenor or I can extend the volume on a certain bucket to increase my risk profile. How much that will come, there will be slightly differential in terms of how the how it will calculate, but basically I can do that. Or I can do both. I can buy a 30-year bond, 100 million rupees. One single bond at 30 years, and that will give me massive duration. Correct? So when I increase duration like this, what do I have to look at? Not only the tenor and the yields are the other thing that I have to look at. What is the other matter that I have to consider when I'm doing that?
The
If I
value
buy
of
a
the
bond for 30 years and put it on my book to increase duration, what is the other matter I have to look at?
the value of the portfolio.
Yes, your existing portfolio, fair enough. But what's the other thing I have to look at?
Coupon rate.
Yes, okay, we say we've taken that into account at the price of the bond, or that coupon is at par with the yield also. That's also okay, we'll say. I have to look at the liquidity of the bond. When it's on the run security and the liquidity of the bond. The reason for that is sometimes when you buy longer dated securities, sometimes you have to put in a provision for illiquidity premium, illiquidity. Meaning, if I need to get out of a 30-year bond, I might not have people willing to buy it from me. While like a 3-year bond, 5-year bond, 2-year bond, there might be plenty of takers. So when at a loss, I can sell. Right? So some of these instruments, like if you are in the US and you're trading the 30-year US Treasury, that's different. Plenty of market for that. People can buy and sell, get out at any time. It's traded it's a very liquid instrument. Emerging market debt, Sri Lanka, a lot of other countries, the longer the period you go, the more illiquid it becomes, because very few people are willing to take long dated risk. Only say, for example, some of the funds like the insurance companies or the pension funds and all that will want to buy long dated instruments to match out their portfolio because they have long dated liabilities created, so they need the assets to balance off their return. But other than that, for most of the banks and trading, they keep everything on a very short period, and they will only buy the longer dated stuff if they feel it's really good opportunity to do that. And then again, like I said, you need to be able to show that I bought a 30-year bond. Can I sell this? Okay, interest rates have come down, but what's the price rate? If there's no market code for it, what's the point? How can you value it? So you might have to keep a massive liquidity premium provision for it to mitigate that illiquidity of the bond. Anyway, that's a separate thing. So basically, you'll understand this. Through the modified duration, you can calculate if there is a percentage move, 1 basis points or 1% or whatever move, how the value of the bond will change, which we discussed already. So let's look at the next one. Consider a bond maturing in 5 years. Coupon is 10%. Yeah. And actual value of the bond is whatever the bond is. So interest rate change is basically yield is 11. Actual value is this. New value is basically this. Based on the coupon and the yield, if the yield interest rates go up 1% from 10% to 11%, right, the actual value will move based on modified duration to this price. So this is the same thing it's giving you here. A 9 basis points change in the price of the bond, a 9-cent change in the price of the bond. Interest rates go up to the same thing, 37. Go down by 37 basis points, depending on the trade. Right. Okay. Any questions, Dr. Rao?
Sir, can you explain that when the market used to going up, how that duration affects? You mentioned that duration should be low or high.
Market rates go up, the duration doesn't change, but the price will go down.
No, the duration should be high or low.
What do you mean high or low?
That means who is going to more benefited when duration is when who has the low duration or high duration?
If market rates are going up, low duration will be the person with the lower duration will benefit. If yields go up, because then his loss is less. If yields come down, right, then the guy with the higher duration will benefit more, because interest rates have gone down, price has gone up, he has a higher duration, he has a higher return.
Okay, sir. Okay.
So next concept is convexity. This is based on the shape of the yield curve and the slot. Basically, the loss of profit or whatever is slightly different to what the modified duration will be because of the shape of the yield curve. So, for example, looking at the yield curve here, P1 minus P2, P minus P1 is greater than P minus P2. This part of the curve with a similar interest rate move has a bigger impact than this part of the curve minus this part of the curve. In other words, if you can see the shape here, the change here is bigger than the change here. So if Y2 to Y interest rates go down or yields go down, the actual change in the price is less here than Y to Y1, where the actual change in the price is greater. This is coming because of the way the curve is. It's not a linear curve. It's a the interest rate curve is not linear. So because it's not linear, because of the shape, the actual change in price is slightly different, and that concept is called convexity. So that comes out when you do the final calculations. You can see that difference. That's why you don't see a percentage increase or decrease in the price. Yields doesn't have the same impact on the price. 1% is 3%, 2% is 6%. It doesn't have the same impact because depending on the point of the curve that it's moving from, the price will basically vary based on that. And that thing is called the convex or convexity of the curve. Is that clear?
Yes, sir.
Right. Duration of a bond. Let's look at the interpretation further into duration. If you are looking into zero coupon bond, duration of a 7% 5-year bond is 4.3. Okay. This bond has the same price quality as a zero coupon bond of 4.3 to maturity. Yeah. Duration of a bond is the maturity of an equivalent zero coupon bond. You agree with that, no? So if I say a bond has a coupon and we calculate the duration and say, okay, this bond is 4.3% based on the coupon. Or if I tell you that the bond has the same price volatility as zero coupon bond of a year of 4.3 maturity, I'm calculating the same thing, right? Let me show you the example, then you will understand. Look at this one. Same bond, zero different coupons, duration 5 years, duration 4.3%. This has no coupon. Now, if I tell you, if I give you this 4.34 and I give you a zero coupon bond with a duration of 4.34, both are equal, right? If I tell you the zero coupon bond and the yield is slightly different, maybe the yield has now gone to 8% or something like that, right? And the duration is 4.34, but it's a 5-year zero coupon with a higher yield, but the duration is the same. Then can I tell you that basically duration yield has gone to 4%? Then can I tell you that basically the duration is the same for each bond? So this is also 4.34 because the yield is different. This and this will be the same, right? Then 4.34 and 4.34. Although there is no coupon, I've adjusted the yield and brought the duration down. Yeah? Can I say that? Both are equal?
Yes.
Yeah. So that's what it's trying to say here. It's trying to say that you can have a zero coupon bond with 4.3 years to maturity, or you can have a 5-year bond, a 7% 5-year bond or whatever it is, with coupons also with 4.3%. Duration, both bonds are equal. So what is the bottom line to it? Whether there are coupons or no coupons, you have to look at the duration. If the durations are equal, whether the bond has a coupon or doesn't have a coupon, ultimately it's the same value. Same type of bond you're buying. But if you buy a bond that's 5 years duration and 4.3 years duration with a coupon, it's not the same because the 5-year duration with zero coupon is a higher risk bond because it's a no coupons and higher duration. The one with the coupon and 4.3 is lesser risk because it has a coupon coming in and duration is coming down. If the zero coupon is 5 years and you buy a bond that has 5.5 years duration, even with a coupon, that 5.5 duration bond is a higher risk because even with the coupons, you're still extending your duration by buying that bond for whatever reason, through the yield and whatever. You compare duration to see whether the bond you're buying is a higher or lower risk. If the duration is equal, it's an equal risk you're putting on your book. Is that clear? If the duration is equal, you're buying the equal amount of risk onto your books. Any questions? Right. Okay. Next one. Yeah. So basically, duration is the time needed to offset the effects of change in reinvestment income and capital value. So we discussed that already. Okay, so I don't want to go too much into this, but market value, weighted average of all assets in the portfolio. So now what we've been discussing all this time is at a securities level, change in one security, what's the duration of that. Now this particular thing is to calculate the sum of all these securities. If, for example, the duration of your portfolio, so what I was talking about earlier, when I want a DV1 of a portfolio, I'm looking at a portfolio when I ask for DV1, I'm not asking about one security, I'm asking for the entire portfolio. But in most cases, sometimes you have it in both ways. You can take one product and say, okay, what is your DV1 on that particular instrument? If the yield moves up X amount or down, what is the impact on one single instrument? But in most cases, when you are looking at it at a very holistic level, at a thing, you're looking at it from a portfolio point of view, at least at a management level. At a portfolio point of view, you're trying to look at what the impact of duration would be if the yields go up or down, what the dollar impact of your portfolio will be based on that move. So you need the duration at a portfolio level in order to arrive at what your DV1 will be at a portfolio level. So how do you do that? You take the sum of the duration of all the securities you have and the market weighted average value of all those securities, basically, and come up with what the portfolio duration looks like. So you take the same thing, duration of the portfolio divided by 1 over the portfolio yield. So in other words, modified duration in this portfolio is sum of the modified duration of the bonds or whatever you're holding into the move in the weighted average yield of the whole portfolio. It's basically the same thing that we discussed earlier, but as a sum. Is that clear?
So how do we calculate the W1, sir? Yeah.
Weighted average yield. So you take the, you're talking about W1 here, right?
Yes.
This one, right? So you take the bond, yield change on that bond into the, say, rupee value of it. And then you take the second bond, 3 years, into the yield change of that into the rupee value. And then you add up the values and the yield change and you come up with a weighted average yield change. So for example, your 2-year bond could have changed by 1% and had a X amount of a rupee value change on your portfolio. The 3-year bond could have had 1% change and had this much of value. So you look at it from each of the buckets, you take the value, rupee value change or dollar value change into the total portfolio value and come up with, and on effect, if there's a 1% move or 1% change in interest rates, at a portfolio level, how much has the yield changed by? 1%, 2%, 3%, 4% at a portfolio level. So you can have 1% move on one security, but because the other security has not moved by that much, right? It could be like 0.8%. So the market value of the weighted security could be less than the actual move in one single security. So you take the weighted average basically. Because you're looking at a portfolio. So in other words, like I said, you could have 3-year securities, 5-year securities, 1-year securities, but you could have more 3 years than the 2-year securities. So your market value of weight of the security, you could have a higher loss on one, a lower loss on the other one. And then you look at based on that, you look at, okay, the percentage move up has impacted this part of my interest securities less or more than it has impacted the other part of my security. So in other words, the weighted impact is more or less than the actual change in the interest rates basically.
So here market value means what, sir?
Sorry?
Market value.
So if you look at this, duration of the portfolio into 1% or whatever the percentage move in there, or else total of the modified duration of the portfolio, total of the duration of the bond into market value. So market value is the weighted value of the security. So in other words, can I explain that to you? So for example, yeah, okay. So if you take the security in its pure sense, one security will have a market value of 95 based on where the yields are, correct?
Yeah, the market value means is the price.
Price of the security, exactly, yeah. So you take the weighted average of the price, basically.
Okay, sir. Okay.
Fine, okay, that's what you want to know, right? Right, okay, so look at this one. A portfolio consists of foreign bonds, 5-year 10% coupon, 10-year 10%, 5-year 8%, trading at 100, so all at par. And you have invested 1 million in bond A, 5 million in bond B, and 2 million in bond C. Find the duration and modified duration of that portfolio. Interest rate swap. Duration of interest rate is obtained by computing the duration of the fixed and floating sides of the swap. Consider 5-year swap, pay fixed 7, receive 6-month LIBOR. Duration of the fixed rate swap would be 5-year fixed bond selling at par. Duration is 5.5. Okay, one second. Let's go to this. Okay, let's look at the first one first. Okay, so look at this example first before we go to the next one. A bond portfolio consists of the following bonds. 5 years 10%, trading at 100. 10-year 10%, trading at 100, and 5-year trading at. So what have you done? You invested 1 million in bond A, 5 million in bond B, and 2 million in bond C. Okay, now I'm not going to calculate the duration here, but in your eyes, what is the bond with the longest duration? Yeah.
B.
B. What is the bond with the shortest duration?
A.
A. Why is it short? Because both are 5 years.
Coupon.
Coupon is high. Very good. Now, looking at his investments, right? What has he done here? What kind of portfolio has he built? Looking at his investments. Now, point number 2 in this, you have invested 1 million in bond A, 5 million in bond B, and 2 million in bond C. Now, what kind of portfolio is he trying to achieve here?
Higher duration one, right?
Higher duration, right? Why do you say higher duration?
Because most of the weight has gone to the higher duration ones, and least amount has gone for the bond A. That is.
That's right. So he has a total portfolio of how much? 8 million rupees. And 8 million rupees, the majority of his 8 million has gone into a 10-year bond at 10% coupon. Although the coupon is high, the duration is high because of the maturity. Then he has put 2 million into 5-year and 5-year bond C, which is 8% coupon. So we increased the duration on that as well. And then he has put only 1 million the 5 years. So basically his duration without calculating it here would be effectively closer to the 10 years, then it would be not 10 years, but close above 5 years, then it would be below 5 years. You'll agree with that?
Yes, sir.
Okay, so then in terms of finding the duration, how would you find the duration on this? Let's go back to the formula. How would you find the duration on this one? First formula, you will take the total of the cash flows for each of the periods, present value that, and then you will come up with the total of the each of the cash flows on top there on the formula, and you will then basically PV that to get the actual duration of the bond. So let's look at step by step. Calculate the timing and magnitude of each cash flow associated with the instrument. So you know that there is a coupon and there is how often you're getting paid the coupon. You present value each of those cash flows to find the total of all the PVs. Yeah. And then you find the weighted average of each of the PV of the cash flows. Yeah. Don't worry, these calculations won't necessarily come for you. I just want you all to understand the theory behind it more than the calculation itself. Yeah. And then once you have that, you have the duration. So you will have a duration on that one that is less than divide step 3 by step 2. Okay. You will, once you have that, you will have the effective duration here, and then to modify duration, you take that number and you will change it by one of the 1 percentage point move in the yield curve, and how that will impact based on the coupons per year. So effectively, without going into the calculations, we can do that later on. But for the moment, what I want you to understand is that based on this, the duration of this will be a higher duration, right? And based on the coupon rates, you will arrive at what the modified duration will be for the change in that particular duration. So in this case, the person putting on this portfolio is looking at creating a longer duration portfolio, because their view may be that interest rates are coming down or whatever it is. Why is the duration of an interest rate swap important? What is the interest rate swap first itself? What is the interest rate swap?
Exchange of interest rates.
Sorry?
Exchange of interest rates.
So how does it work?
The floating to fixed and the fixed to floating, like that.
Yeah, so if I enter into a floating to fixed interest rate swap, what am I trying to say?
I pay floating and get fixed.
No, I want to interest from floating to fixed.
View is that interest will go up.
So you want to fix your rates. So the guy who is quoting the rate to me, say I'm the bank, you are the customer, you come to me and say, I want to fix my rate. The person who's quoting the rate to me will then say, okay, fine, I'll quote you a rate, no problem. But let me quote you the rate. So how do I quote the rate? How do I quote somebody a fixed rate when even I don't know what's going to happen with the interest rates in the future? How would I quote a rate to somebody as a fixed rate when even I don't know where the rate is going to be? Do I care what the rate is going to be in the future when I quote the fixed rate to him? I'm the bank. You want to fix your rate. You're doing 6 months LIBOR at the moment. You come and tell me, Perry, can I have a fixed rate for 5 years on a swap? I will say, okay, fine, let me quote you the rate. Yeah. And I come back and quote you 7% for that. How have I got that 7%?
From the percent investments or whatever?
Not necessarily.
You have to hedge that portfolio in a particular investment.
How do I quote it based? I don't have anything to hedge against, but I still have to quote a rate. How do I quote it? I have to back it out somewhere, right? Agreed? That's what you're telling me now? You're telling me I have to back it out somewhere, no? If I quote him a fixed rate, I might have to go and do the reverse at some other place, right? How do I figure out what that rate is? I will look at the curve. I will look at the interest rate curve. I will look at the swap. I will look at what he's giving me now. When he's saying, I want to convert my floating debt or floating loan into a fixed loan, what does that loan have? The loan has repayments, right? Coupons coming up. So it's a 5-year loan with semi-annual payments or annual payments or monthly payments, right? That is fixed, floating every 6 months, correct?
Yes, sir.
Yeah. So now he'll give me all those cash flows and say, this is my cash flow. I want to convert this floating loan I have into a fixed loan. I will take all that and what should I calculate based on that? What should I calculate on the 5-year rate, 5-year?
So you can't calculate a present value, right? Because you wouldn't know the changes in the rates.
Exactly. Good question. Good point. I will take the cash flow and I'll look at the current curve, interest rate curve, ITM, right? And I'll PV each of those cash flows to arrive at the current duration of the curve. So 5 years with monthly payments or 5 year with semi-annual payments, which will have the higher duration?
Semi-annual.
Semi-annual will have the higher duration. 5 years loan paid at maturity as opposed to 5 years coupons every year, which will have the higher duration.
Maturity.
At maturity. So now I know the period, right? So now I know the 5-year loan that has been given to me is actually a 3.5-year loan or 3-year loan. Agreed? Because of the duration. The duration is actually 3, right?
Okay, yeah.
Then I will take that 3 years and look at what my DB1 is for 3 years. If 1 basis points change in that curve, for 1 basis point, what is my dollar value on that basically? So $1,000, $2,000. Then what will I tell the guy? Okay, Currently, I can quote you 7% for that based on my current break-even rate. Add a margin if you have to, and say, okay, 7% is what I can quote you based on the current port structure or the cash flows that you have shown me and the current interest rate curve. If the interest rate curve is upward sloping, flat or whatever, the rate will change because I have to construct my PV or my cash flows based on where the curve is and arrive at what my duration is. Agreed? So if the curve is inverted, that means if the interest rate curve is lower in the forward than it is in the spot market, then the duration can actually be less as well, right? So anyway, bottom line is you arrive at a duration, and based on that duration, you will say, okay, based on that particular point in the curve and what my break-even DV1 is, I can go to 7% for that. So it's not a hypothetical rate. It's very much a rate based. Yeah.
Sorry. When you say it's a 5-year and you have a duration of say 3.5, and then would you look at what is the 3-year rate in the curve? Is it how it works?
It's approximately what the 3-year will be. But so, if example, if the 3-year rate is 7% and the 5-year rate is 9%, right? Your interest rate swap rate that you get from the bank should be closer to the 7%, not the 9%.
Okay.
But that bank will look at it from a point of view of if there is a percentage move up on the bond, what the DV1 impact is. So if the DV1 impact is $1,000, they might go to 7.2 or 7.3. But in effect, yes, it should be closer to the 3-year.
Okay.
Clear?
Yes.
So,
yes.
so based on that, you have this situation where the interest rate swap is quoted to you based on the shape of the curve, yield curve, what the look of the yield curve is, and obviously then finally the margin that you want. And banks, okay, 7% of it, 7% is what we want to quote.
But the values that you use to calculate the duration for this the flexible one would be an approximation, right? You would know the for the flexible rate loan, you would know how the interest would turn out, right? For the maybe.
Yeah. So when I quote for the swap, I'm looking at the swap curve.
Okay.
So I don't care about the loan. The loan is already done. The loan will be a separate instrument that happens on the balance sheet. Interest rate swap is off the balance sheet, and it's a separate contract.
Yeah.
So
but you said that to calculate the duration, you would want the future payments. So how much?
yeah, that we know. No? That we know what the interest payments are. No? Not we don't know the interest. Yeah, what you're saying is that if the coupon is known. No?
Okay.
It's a 5-year loan, but you know how much you're paying the monthly. I'm not talking about the interest rate. I'm talking about the repayments, principal repayments.
But still, if it is a floating rate that you're going to make it to a fixed, you wouldn't know maybe 2-3 payments down the line how would the interest rate be, right?
I don't care about the interest rate. I only want to know the principal.
Okay.
Because interest rate is what you're trying to hedge, right?
Yeah.
So interest rate can change, and then that will be taken separately based on the swap 7% against LIBOR 0.5%. You'll exchange based on that. But for me to calculate at that point in time the value of that 7% interest rate or fixed rate, I just need to know how much of cash flows I'm getting to in order to approximate where the duration is. That's it.
Okay.
Now, the interest component coming in is separate. I don't care about that. I'm just worried about the principal repayment. That's all. So in order to come up with, okay, this is the actual value of the bond because I know the principal repayment. But if you look at this particular slide, you answers your question. The effective duration here is taken as you're just taking the half year, which is 6 month LIBOR, against the duration. The actual duration is 3.8. You understand what I'm saying? You're taking the duration, taking 6 months into account as the duration. You have to answer here they've arrived at a 5 year with these coupons and all to be 4.3. But to talk about the duration from interest perspective, they've taken a half a year to say the actual duration is 3.8.
Right. Okay.
To adjust for that very thing that you just mentioned.
Okay. Yeah, makes sense. Thank you, sir.
Okay, so small changes in yield, parallel shift in the yield curve, instantaneous yield change. So yeah, so when you're doing this, and when you're making these calculations and taking DV1, etc., you're taking that these are for small changes in yields. You're not taking like 3% changes in yield curve. You're assuming that the yield curve is changing parallelly. Obviously, there are instances where convexity comes in as well. And the yield change is instantaneous. Like, if you say there's a 0.5% change in rates, that it happens at once. It doesn't take time to happen. And that's how the whole assumption around the DV1 and the duration yield impact on duration is taken into account. Yeah, so this is what we've already discussed. The duration of a zero coupon bond equals its maturity. The duration of a coupon paying bond is less than its maturity. So we agree, we've done all that. Duration of a floating rate bond and that sells at par equals its repricing maturity. That's also correct. Other things remaining the same. The greater the coupon, the lower is the duration. Agreed. Other things remaining the same. The greater the yield, the lower is the duration. Other things remaining the same. The greater the maturity, the greater the duration. Okay. Other things remaining the same. The greater the frequency of bond coupon payments, the lower is the duration. The duration of a coupon paying bond decreases slower than the time. That is, with the passage of 1 calendar year, the duration of a coupon paying bond decreases by less than 1 year. So we've done all that. Just go through that. Right. Okay. Don't want to go in too much into this at the moment. Any questions so far? Right. What we will do is, I want some time for you all to absorb this also. What we will do is, okay, we have about another half an hour. We can finish the equity part of it and move into the next section. Or I don't mind. Okay, so can I ask you a question? How are we all done with the rest of the sections on this? Is there anything else that you all want me to touch on once more? On the ALM side, on the treasury management side, we'll have a bit of revision as well. But you all want to touch on anything in particular in the last 3 lessons that we've done? Is there any area that was not too clear? Okay, good. So then what we'll do is we'll do this bit now. This is not too important. I'm not going to go into detail on equity because that is not an area that we look at on an active basis. But we are going to, and honestly, it's not an area that we will necessarily test you on also because it's hardly been used at the moment, and I don't think it's too relevant. Purely for academic reasons, how you calculate it is mentioned here. And I think it's good to know, but I can tell you that it's not going to be something that I will be keen to test you on because it's a bit more complex. Yeah. And I would think very few institutions locally, at least from the banks, will look at it because very few people actually trade on the managed equity portfolio like that. So basically how it will work is you have an asset portfolio of 100 billion. Look at the example straight away with a duration of 3 years, liability of 90 and duration of 1 year. So basically you build the portfolio based on your duration. Assets minus liabilities, market value of assets, market value of liabilities into the duration of the assets into the duration of the liabilities minus the duration of liabilities. You take that and you arrive at a modified duration for the equity portfolio we have, right? Like I said, it's just a calculation. You can assume this is, and this will be more volatile because your equity portfolio changes will be much more rapid than it would be for your changes in your bond yields and things like that, because interest rates will change much slower than what the bond rates yields will change by. Next one is hedging the interest rates on the balance sheet. So basically your assets and your liabilities, just decide from a corporate perspective or firm perspective how much of a liabilities or how much of interest rates you want to actually hedge. You work out your average duration on your deposits and your assets, or the liabilities and your assets, and you figure out from there how much of the portfolio you want to hedge, right? So how would you hedge your balance sheet? What is the instrument you would use to figure out what kind of hedge you would, or what kind of look at it this way. You've created various assets, you've created various liabilities, right? You have average duration based on your assets of 100 million, your liabilities of 90 million, your duration of your assets of 3, and your base duration of your liabilities of 1. Now you're carrying a basically overall you want to hedge your risk on your existing duration of 3.67 on your book. Yeah. Now you got to solve for what amount that you want to hedge, because now you've created assets of 100. Your liabilities is this. Now you need to sort of balance this off. You figure out, okay, I have now the duration mismatch that I have is in dollar-rupee terms or whatever is 57, based on the gap that you have here to match these two formula to equal 0. For 57, you've got to figure out, do I go out now and do an interest rate swap to hedge that difference? So in other words, you have created an asset of 100. You've lent money of 100 for 3 years. You borrowed money of 90 for 1 year, right? And you know that your duration for the assets is greater than your duration for your liabilities. In order to make up the difference, like I said, 90 million against 100 million, even though it's like only a 10 million gap here. When you calculate from duration terms, it's actually a gap of 3.67, because in order for you to arrive at 0, you have to increase the liability value or the duration number, the duration gap, by 57 million of liabilities in order for you to be able to make the differential. Now, does it mean that you have to go and borrow, create deposits for 57 million? Oh, how do you hedge that? Does it mean that you have to go and raise deposits again of 57 million? You'll understand this first and foremost. Company has assets of 100 million for 3 years. Company has liabilities of 90 million for 1 year. The duration on his assets is 300. Duration on his liabilities is 90. In order to make his assets and liabilities match, right, he has to raise his duration by 3.67. In other words, he has to increase his liabilities duration. How does he do it? Does he go out and borrow rupees from 57 million? Is it a problem with cash flow that he has? Or what is the issue that he has? What is the mismatch here? Is it a liability versus asset mismatch necessarily, or what is the mismatch?
It's a duration mismatch, no, sir?
It's a duration mismatch. So how do I go and, outside of borrowing 57 million for 3 years, how do I go and, if I'm happy with the volume I have now, how do I correct the duration mismatch?
Adjust the portfolio mix.
How do I adjust the portfolio? You can adjust the portfolio. If not, I don't want to adjust. I'm happy with the portfolio I have now also. I'm happy with 1 year liabilities and 3 year assets. I want to adjust also. I can enter into an interest rate swap to pay fixed, which will pay fixed effectively, meaning that I am now going to go out there and borrow or hedge my portfolio by borrowing 3 year assets, basically 3 year liabilities, sorry, at a fixed rate. That way, I don't change my notional cash flows, but I manage my interest rate duration. I have a 3 year fixed commitment now on my books. Does that make sense? See, manager wants to, yes, what has happened here is, assume it's decided to use the interest rate swap to hedge the duration of the swap. So basically, I will go out there and do a swap for 57 million rupees and say, okay, fine. I have now, basically, I'm paying fixed and I'm basically now paying floating or whatever it is. And basically, I'm going to basically make sure that I have my mismatch in terms of my assets, which I've raised and I'm receiving fixed for now, or whatever this is. I've raised by doing a interest rate swap separately, which will effectively say I have a 3 year commitment on my books now, which basically nullifies the impact of not having liabilities to match the duration of the assets, because now I will create a liability through the swap of balance sheet. So even if interest rates go up further, and I then find myself basically having to raise deposits at a higher rate, I will only be raising 90 million here. Fortunately, I'm basically paying fixed here, and I have already hedged my interest rate risk on the higher interest rate going up because I have basically done a swap and I'm paying fixed for 57 million. So even if I had to go and raise interest, if interest rates go to 15%, and I have to actually take deposits at 15% for another 57 million, I've hedged it by paying fixed on 57 million here at whatever 8% or 9%, or whatever the rates were at the time of doing this. Is that clear? So if the management wants to preserve the capital and asset ratio, you can use duration of that as well. So duration of assets should equal your duration of equity. In order to do that, you will calculate it at a point in time as to what your duration of your assets are against your liabilities, and then basically arrive at a number there. So, like I said earlier, the relationship between duration of equity and leverage, or rather duration and assets and liability, you don't need to necessarily raise deposits or create loans for it. You can do it with other instruments, but because you can't necessarily change the portfolio mix overnight like that, so you have to be aware of that when you're looking at it. Right. Okay, I'll stop it there for the moment because I think that's a lot of content. Any questions?
So are there any instrument available to for that interest rate is minimized that you mentioned, swap other than that?
So in a treasury, that
forward rate
how
agreements,
frequently
sorry.
they need to do the duration analysis?
Okay, so first question on the products, right? I think the main thing is that you have the swap and you have the FRAs, forward rate agreements, which is basically, if you look at the swap, it's a combination of forward rate agreements. So from a forward rate agreement, you can decide in 6 months' time what the 6-month rate will be, and you can lock it in. FRAs, as they're called, right? Interest rate swap, as we discussed, is the other option. There are variations of that. There's something called the overnight index swaps, which unfortunately we don't have an overnight index market to do the benchmark it against. But yeah, those are the main ones. FRAs and IRSs basically are the two main instruments. In Sri Lanka, unfortunately, we don't have an active interest rate swap market or a FRA market. But overseas, and if you're doing it against foreign currency, foreign exchange, there's a very active IRS market for that. The other one is, there's also one more, interest rate options. We don't have it here, but again, US advanced markets, you have it. Interest rates options are basically where you can buy a put or a call or a combination of a put and a call, depending on the premium you want to pay or don't pay, to hedge yourself against interest rates going up. For that, the bank that's quoting you will look at, outside of the swap rates and stuff that we have discussed today, they will look at the volatility in the interest rate curve, and they will basically, based on the volatility, arrive at a premium that you need to pay them to get into a optional contract. So in other words, you say, look, I will fix my rate, interest rate, if it goes above 2%, the bank will say, okay, fine, if your rate goes above 2, we will fix your rate at 2%. It goes to 3-4%, you can call on your option and you can basically execute your option. If the rate comes below 2% and you're not, obviously you don't want to fix it at that point because the market rate is lower than your option rate, you can walk away from the contract. The difference being that from a swap being that on an option, you need to pay a premium usually, unless you do a zero cost structure. For a interest rate swap, there's no premium to be paid upfront. You just fix it at the rate and that's about it. So the main two categories are floating to fixed, fixed to floating through an interest rate swap or FRA, or buying an interest rate option. But unfortunately, we can't do both of it here at the moment. Sorry, what was the second question you asked me? Somebody else asked me another question.
I think.
So in Treasury, how frequently we do need to have a duration analysis? Is there any norm for that?
Well, what happens is that generally the fixed income guys mainly and the trading team will have a daily look at their book to figure out what the duration is. Yeah, that's the first thing. Generally, the DV1 is a limit that you have. So if your DV1 is moving up, you need to see that, or down. That's a daily limit that will be monitored. So see whether you're breaching a risk limit, because that is the calculation of what your risk is. No, end of the day, if your DV1 is $10,000 and you're suddenly at 9,999, right, and then suddenly is move, you're going to be, you put on a portfolio or you buy a bond, another bond, your DV1 can be breaching that based on your portfolio mix. So that one risk middle office will monitor that on a day-to-day basis. So the duration is looked at daily, where how actively or how in depth you will go will depend on your level of risk that you're taking, basically.
This is that mark-to-market loss limit and duration limit is two different things, no?
Two different things. Yeah, two different things. Mark-to-market loss limit is different. The DV1 limit or the duration limit that you have is more to do with your trading limits. The mark-to-market loss limit you could have on each of your products as a saying, this is the maximum mark-to-market risk. The DV1 will say, look, you are allowed to carry a trading position with a DV1 of $10,000. So even if it's positive or negative, mark-to-market positive or negative, if your DV1
mostly with the trading book, no, sir?
Yeah, exactly. If your DV1 is $15,000, right, and your limit is 10,000, whether interest rates have gone down or up, or you're making money or not, you breached your limit. You shouldn't be carrying that kind of portfolio. So, for example, if I feel interest rates are going down, I won't go and buy a 30-year bond. Suddenly, my DV1 comes up where my limit should be $10,000. It shoots to 15,000, right? Now, tomorrow interest rates come down. I make a lot of money because I've increased my DV1, but have I done the right thing? No, I've not, because I bought a 30-year bond and increased my DV1 without getting approval for it to increase my DV1 limit. Because if the interest rates went up the following day, I would have lost that money, right? Because my risk is beyond my allowed parameters. So tomorrow, if I keep within my loss limits, and tomorrow the rate goes up by 1%, I will lose money. My view was wrong, but I've kept it to my limits. Mark-to-market will show that I've lost money, but I've kept my DV1 limit intact. At least when I took the position, yeah. But next day I will have a negative mark-to-market. Then your negative mark-to-market will come and kick in as, okay, are you within your negative mark-to-market limits? Do you need to exit some of the portfolio to bring it within limits? Even though your DV1 limits won't change, it could still be the same.
exit means you will incur a loss, no, sir?
You will incur a loss, yes, but you will want to exit it because you might be exceeding your loss limits on your mark-to-market basically separately. Once you exit one or two instruments, you might be back again in line with your mark negative limits, so it's fine, you can keep it, but your DV1 could be effectively the same because you might just get rid of a 5-year bond and put on a 3-year bond, for example. You can get rid of the 5-year bond to come in within your limits, but maybe you can put a 3-year bond and keep your DV1 within the same parameters or whatever, and be still within your mark-to-market limits as well.
Sir, to maintain the risk appetite limit, that means in DB1 or in the mark-to-market losses, is it a good strategy from exit from such an investment while having a loss in your PNL?
Depends on your. One thing is you should always have exit mechanism because you cannot hold on to an instrument expecting it to perpetually go up or down. So if you have you should have stop loss limits on your trading book. So if you have stop loss limits, those stop loss limits have to be triggered then, if that's the case. You can't have a situation where on a trading book you're holding on and you're making massive losses, right? But you're holding on waiting for the it to be picked up, basically. If your stop losses are being triggered, then you have to cut. That's why the stop loss limits are now. Whether the stop loss limits are sufficient or not sufficient, that's a separate conversation you need to have. Whether they have to increase the limits or do whatever, that is something that you need to discuss separately, basically, with your risk teams and your trading teams, and adjust that according to that change, basically.
So what does the DV mean, sir?
Sorry?
DV means, sir? DV1?
Dollar value one.
That means the BPV is the same?
Yes.
Okay.
Basis point value. Okay, so
Sir, small question. In case of we are fixing the rates, we are looking at usually the yield curve.
the yield curve at that point in time, yes, for the interest rate swap. There is a separate curve for interest rate swaps. If you don't have one, you look at the bond curve or something like that. But generally, you will look at the interest rate swap curve and say, okay, this is the curve that we can use to fix our interest rates.
So we have to look at our portfolio also, no, sir?
Forget about the portfolio yield. That doesn't matter. Those are historic rates. Those are taken and done. You just have to look at your repayment. That's all. Forget about where you bought your risk in that. That doesn't really matter. That's your internal cost of it. Always when you're valuing something, you have to value it against the market, not against where because it's opportunity cost at the end of the day. See, you're looking backwards and looking at your existing book and saying, okay, right, I'm looking at where I raised my cost of funds, therefore I got to lend it. If I've borrowed at 3%, lend it at 5%. That doesn't make sense. If you can lend it at 7%, why are you lending it at 5%? If you have borrowed something at 3% and you can, now the rate is, and you're lending it at if the rates have come down further, if you have borrowed something at 3% and you try to keep lending it at 7% when the market rates are 5%, you're never going to be able to get somebody. So you'll have to lend it at 5%. So the role of Treasury is to mitigate that risk for the rest of the businesses so that they can lend it at the market rate. Benchmark and lend at the market rate, not at where you borrowed at. Now, if you have an advantage because you have low cost funding or for some reason people want to borrow from you and you can lend at a higher rate, that's different. But in a perfect or a normal market situation, it's always opportunity cost. So your opportunity cost is looking at the yield curve, basically. Not at where you raise that loan at or deposit at or lend at. Does that answer your questions?
Yes, what I mean, sir, that position, like whether we have enough liquid or whether we have assets to do that transaction, like that things. We have
Enough liquidity or enough assets? Meaning?
means our composition of our portfolio. Do we have to consider?
Yeah, so you have now created assets and taken liabilities in, right? Now, when you look at a swap, you are looking at it as to how you position your interest rates and how you manage your duration. That will depend on your existing assets and liabilities, not what you have bought in it, not the rates. What you want to see is, do you want to increase duration, reduce duration, and what the market yields are to do it. And are these good rates to pay interest fixed on the interest rates or keep it floating or not? But that's just to manage the duration and the modified duration. In other words, that's just to manage the tenor of your risk and the yield at which you're buying that in, not based on what you've already bought. So, for example, if I decide to buy a 5-year bond today, it's based on where the bond yield is, because I feel interest rates are going up, down, or whatever. Or if I decide I want to sell my bond today, 5-year bond today, it's because I feel interest rates are going up and I don't want to hold on to these bonds anymore. I want to get back into rupees, get rid of these bonds even at a loss, and hold on to my rupees and buy it when it comes back again. And take my hit if I have to, basically.
Okay, sir. Thank you. So other thing is with regard to markets, how do we can we get the market is excess or short in liquidity from that rates, deposit rate and rates of the central banks?
Sorry, I didn't understand the question. Tell me again.
Whether we can get an idea about the market liquidity position from that rates, that means the amount of overnight markets, the lending rates of the central bank and deposit rates, and difference. Can we get an understanding about the liquidity in the market from that? How do we get that?
Okay. All right. Before I get that's a separate thing, I will give you a question thing on that. Right now, what I would like you all to do is to, we have another 5 minutes or so. I'll answer the question, but I think if you can go through the remaining part of the questionnaire by yourself, and if there are any questions, just reach out to me. If you are not sure for any of these questions, do these questions by yourself at home. 64 to 670. If there's any difficulty, we will address it during the revision classes we do. I don't want to have a separate class just to discuss these ones. We have stopped at slide number 56 at the moment. The rest of it is about the advantages and disadvantages and strategies in terms of interest rate risk management. I will touch some of that during the revision as well, but for questions 64, slide 64 to slide 71, write out at home, but we will go through it during our revision sessions as well. Okay? Because I think we did a lot today. I don't want to go into too much more content at the moment. To answer your question about liquidity, which is outside of this, but just you can gauge the market. You want to know how to gauge the market liquidity on a day, is it?
Yes,
Is that what you say?
Yeah.
So generally, you have the STR and the SFR, that's basically the funding rate and the deposit rate, which are now at 5 and 6%. If you look at the market liquidity data given, you can see on a day-to-day basis whether the market has a surplus or negative. Now, these days, I think there was about a 200 million rupee negative, 200 billion rupee negative in the market, especially after the SRR hike on the 1st. and then that took about 140 billion off the market. Anyway, the market was deficit. So one is to look at the market liquidity, surplus or deficit. It straight away tells you that. That's the first gauge, right? The second gauge is to see whether now although we have 5% and 6%, people borrow in between that window. They come in and borrow money market at 5.75 or 5.95, or there'll be like a special repo auction and then they'll borrow at that. Generally, that should be within the 5% and 6% range, because that's the borrowing and lending range given for treasury bills. You can come, pledge your bills and borrow and lend at those rates. If people are borrowing above that, when the say, for example, against effective reverse repo is 6 and somebody is borrowing at 6.1 or 6.2, it has not happened. That will show that there is a lack of treasury bills in the bond market and people actually borrow beyond that 6% range, which will also indicate that there is a shortfall in the market. Yeah, but generally the easiest gauge is to look at the overnight liquidity, whether it's a surplus or deficit in the market. Yeah, that's the first thing. The second aspect of it to look at is the T-bill auctions and weekly T-bill auctions, where you will find that the bids for the auctions and what rates it's going at. These days, the auctions have been undersubscribed, meaning that the bids received have been very much less than what has been, or the bids accepted have been very much less than the yields that they have been offered at. Last 2 weeks ago, I think there was a bond auction, 50 billion. Out of that, I think only 4 billion was taken up every single week. The weekly auctions also are undersubscribed. So what has happened in that instance is, if the bond auctions are undersubscribed, you have either to accept the higher yielding bills and just accept those, or the central bank has to monetize that by basically buying the bills for themselves, or by retiring the existing maturities, or buying the new offer at the years that they have put up, and that means effectively printing money, which will also, if they don't do that, automatically that will result in liquidity falling short in the market, and basically that money that is there, that whoever has bought those bills having to retire it and not get a new infusion of money to be able to manage this. So, for example, if bills have been issued, they are maturing, somebody has to repay it, and they don't have the cash, central bank will print money, give them the cash, they will then take that cash and repay the existing debt. If central bank doesn't repay anything, they have to then go out and say borrow from some other institution to retire the existing debt they have, which basically means borrowing. That means it adds to the surplus, because no new money is being given to them, no new printed money is being given. That will lead to the shortfall increasing. So if there is purchase of bonds or bills are less in the next few weeks, that could lead to months, that could lead to the shortfall in the market increasing. If not, the other option is, if the shortfall should not increase, the yields on those bonds should be raised to a level where there is sufficient bids taken to match to honor the existing commitments that are there at a higher yield. So the market will then basically buy the bonds, and basically no need of printing money to retire the existing debt, and no need of, exactly. But the easiest gauge is to look at the market shortfall on a day-to-day basis. If the shortfall is increasing, then you realize that obviously some of these things that we mentioned are happening, and that shortfall is leading up, which should ideally drive up interest rates. So definitely when the SRR is increased, that takes off 140 billion as of now from the market, which would ideally result in a shortfall being created. But if the shortfall is being reduced by auctions or new printed money, then it will automatically come down as well, because there's new money being pumped into the market as well through the T-bill purchases on the other side. So for the shortfall to keep on going, that purchasing of those has to also stop, And then also the other side of it is that if there are, say for example, purchases of dollars in the market, then also that could lead to rupee liquidity being pumped into the market. If there are no purchases of dollars in the market, the rupee liquidity being pumped in is also reduced. That could also then lead to the shortfall. Did I answer your question?
Yes, thank you. Other thing, the basic idea used by that is difference between that deposit rate and lending rate. No, we can get a basic idea about the market.
Sorry, I didn't get you. What is that?
To get a basic idea of the market liquidity, we can see that deposit rate and lending rate that previous day. No.
Yeah, you can not only you can see what the market shortfall. It gives you the shortfall, how much has been lent, how much has been borrowed, and what the liquidity shortfall is. It'll tell you that data is available if you look at it. And also, like I said, if it has gone above now at the moment, I think as of last Friday, interest rates at people were borrowing at 6%. Previously, money market rates were 5.25%. So after the interest rate hike, it was 50 basis points. Yields have gone up to 6 because the shortfall has increased after the reserve was cut and all that. So now whether that will sustain there or not will depend on how much money is pumped into the market.
Okay, sir. Thank you very much.
Any other questions? Right. Okay. Today was a bit of a long session because it's a bit of a heavy area, but I think overall you should be all right with it because the area will be covered when you all are doing your bond calculations and stuff. So I'll ask Nishant to cover the duration and convexity part of it if he has not already done so. And also on the revision part of it as well. So I think you can understand that a little bit more through that as well. But just the basics of it in terms of understanding how it impacts a portfolio, how it impacts interest rate changes impacted, and just try to get a gauge on how you look at risk from that perspective is very important. Risk from a treasurer's point of view and risk from a back office and middle office point of view, so that when you look at a portfolio, you're not just looking at it from a purely interest rate movement perspective, but in the context of where the actual duration of the book is and how that duration will impact the P&L based on their movements as well. Yeah, that's it. Any other questions? If not, we can call it a day. I will not be here next week. Nishant will start off next week again, like I said, and when we do the revisions, we'll catch up on some of the areas that we've missed out on as well.
So we another 2 modules are there to complete the risk management and regulation and compliance. On that you will be joining, or is this your final session?
This is my final session from the main course content that will be done by Nishant, or some regulation will be done by another gentleman from Central Bank as well. I'm not sure who it will be now. It was to be Mr. Sarjun. I'm not sure who's going to do it this time, but I will not be doing those modules. It will be done by Nishant.
Risk will be done by Mr. Nishant.
Yeah.
Okay, sir, thanks. Is this, if we refer these,
Sorry?
If we refer the things which we discussed today in asset and liability management, the duration analysis, is that enough for our exam, or we will have to refer any other extra?
No, it's enough for your exam, for sure. It's enough for exam. But if you want to understand it a bit more, my view is to just do some reading around it. There are plenty of material on the internet for it, number one. And number two is the area that you did on fixed income, there's an overlap there. So you will understand duration, and when you understand bond pricing and how the bonds work, you'll understand that. But what is done here is sufficient for the exam.
So ALM session is completing today, no?
It is completed today, yeah, correct.
Good. Thank you, sir.
Like I said, we will touch a bit more on the revision on the questions that we didn't do today. I didn't want to go through because it's past time also, but we'll do it when we do the revision part of it.
Thank you, sir.
Okay. Okay, thank you very much. If there's no more questions, have a good Sunday and take care of yourselves. And we'll meet again before the end of the year, hopefully.